Most market participants are not expecting tariffs to last longer than a couple of months.
There are some longer-term positives if we can potentially negotiate some with these tariffs.
The one clear conclusion from Paris is that they are U.S. growth negative.
All these things really aren't sustainable in the long term.
If the full expected tariffs come through, that would likely trigger a recession.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Wednesday, entering a whole new world.
The tariffs are on, and the money is pouring in at a level that we've never seen before. And it's going to be great for us. It's going to be great for other countries. We've been ripped off and abused by countries for many years.
Major tariffs begin across Europe and Asia. The president pushing forward with monster levies on China, sending equities to the biggest four-day slide in more than 5 years, and the bond market offering no place to hide. As the White House keeps the pressure on, the Federal Reserve is not stepping in. One Fed official suggesting policy is in a good place. Is corporate America in a good place? This hour, earnings season begins. Numbers from Delta Airlines are just around the corner. Those numbers about 30 minutes from now.
So how does a company give some sort of forward look at a time of incredible uncertainty across the board, whether it's consumers or corporations? What we heard from Levi's yesterday was a dissonant seeming level of certainty with the reaffirmation of their guidance, saying that tariffs would be surgical, but saying that they had a task force looking forward to what the consumer demand picture would look like. Will Delta have the same approach, or have they gotten already some different guidance from at least consumer purchases?
They need more than a task force right now, that's for sure. This market, the pendulum keeps swinging between deal hopes and tariff threats. The underlying trend, though, is clear. The tariffs keep going up.
The tariffs keep going up, and the tariffs are in place as of today on some 60 trading partners with the United States. Most importantly, the tariff on China, cumulatives, what we have seen in Trump 2.0, is now at 104%. But Jonathan, you nailed it on the head. The pendulum is swinging. Yesterday morning, some hope, glimmers of hope to the market coming out. Talks of phone calls with South Korea. Talks of the president welcoming these calls to negotiate. And then by the end of the evening, what did we hear from the president of Washington, D.C.? The tariffs are coming into place, and there will be more. This time, he's looking at pharmaceuticals.
So in the markets, these are the scores. Since April 2nd, the S&P 500 down around 12%. What's the bond market done? The bond market, the 10-year yield is higher by 20 basis points plus over that period. That's where the pain is right now.
This is a bond market that's losing faith in the influence and power of Scott Bessent, the Treasury Secretary, who is supposed to be the reasonable voice in the room and who is prioritizing the 10-year yield as a metric of success. I would argue that the two most important events this morning and the rest of this day, aside from whatever we might hear in Washington, D.C., number one, Delta earnings. Number two, a $39 billion auction of 10-year notes at 1 p.m. today. Yesterday, a 3-year auction, normally very boring, was not boring. It was not good. It did not come in a well-ordered fashion where primary dealers had to take down a disproportionate amount. What happens with longer duration at a time when you see surging yields on the long end?
Bond yields up across the curve this morning. At the front end up by 6, on 10s up by 8. Your 10-year just short of 440. Coming up this hour, we'll catch up with Andrew Sheets of Morgan Stanley following another wild day in financial markets. Matt Gertken of BCA Research on the highest U.S. tariffs in more than a century. And Alexander Jekov of BNP Paribas as we wait for China's response. We begin this hour with stocks looking to snap a 4-day losing streak as major tariffs begin. Bloomberg's Tyler Kendall joins us now from Washington for more. Tyler, we've started every single show for the past week by saying, are these the rules of the game or can you negotiate? And the message coming from the White House seems to be it's both.
Yeah, good morning, John. Well, exactly right. The White House appears to be walking the line between negotiation and escalation. These are the highest tariffs in more than a century that the U.S. has imposed. But of course, they're higher for others compared to some of our trading partners that have reached out to President Trump. Take China, for example, of course, as you've been talking about, 104% levy that went into place at midnight. But importantly, President Trump yesterday said that he was waiting for Beijing's call. It appears that the White House is really welcoming the outreach from other trading partners as they all try to figure out exactly what they need to do to strike a deal. One thing that is becoming increasingly clear, as we've been talking about, it's going to take more than just eliminating tariff barriers. That's why we're going to be watching closely how those non-tariff barriers, as White House talks about so much, make their way into the conversation in perhaps a more meaningful way. For example, USTR Jamieson Greer on Capitol Hill yesterday telling lawmakers that the U.S.'s message to other countries is if they have a different way to achieve reciprocity, then they want to hear from them. That tracks with what President Trump has been saying, which is that he's looking to make tailor-made deals, not off the rack, in his words. And John, of course, we are laser focused on these so-called reciprocal tariffs, but we'd be remiss if we didn't mention that this White House really does appear undaunted, particularly by the market's reaction. President Trump yesterday pledging that sector-specific tariffs are still coming. He says next up are pharmaceuticals.
Tyler Kendall with the latest down in Washington, D.C. More from Tyler later on this morning. Tyler mentioning Jamieson Greer on Capitol Hill. The U.S. Trade Representative taking some heat yesterday.
Took some heat, not just from the Democrats, which is what was so interesting. You had the likes of Senator Ron Johnson coming out and saying, I don't normally agree with the other side of the aisle with you sitting here, Mr. Greer, but I do today because I am worried that potentially this is going to hit small businesses and you can have bankruptcies. And other Republicans talking about the fact that they're worried about inflation and the consumer and said, I hope you're right.
So what should investors do? Andrew Sheets of Morgan Stanley seeing downside risk to growth, upside risk to inflation, and writing the following. We see no Fed cuts this year in our base case. The probability of recession in the US and Europe has moved higher. Andrew joins us now for more. Andrew, welcome to the program. We'll focus on corporate credit with you. That's what you focus on. Can we just start with, though, these moves in the bond market? Andrew, what is driving Treasury yields higher and not lower?
Yeah, thanks. Good morning. It's great to be here with you. So I think at this point, it's uncertainty. And I think there are a lot of competing theories. And that's everything from a lack of foreign demand to these large budget resolutions that you see coming out of the U.S. House and Senate, and to just the fact that there's a lot of volatility. And I think investors everywhere are trying to get exposures down. But I think as you open the program, I think that's exactly the right focus and what investors have on their mind. There's a lot of uncertainty. There are a lot of competing narratives for what the administration is trying to accomplish. A number of those goals seem to be kind of at odds with each other. And I think investors are also very uncertain around the timeline. Again, I think there's two very different competing narratives of what the goal is here. One is a negotiation tactic, which by implication is temporary. But there's also this idea that, well, if it's temporary, you're not going to get the type of reshoring, the type of big structural change that the administration's also talking about. And so, these goals being in tension and no sign of resolution, I think, is causing investors to step back. And, long-dated treasuries are very volatile assets. And that's a place that maybe is one reason why you're seeing more underperformance there.
Long-term treasuries are a very volatile asset. Let's just sit on that for a second. This is not the way it has been traditionally. This has been a haven, a place of reprieve during times of turmoil. There are many huge sweeping narratives that people are coming out in terms of seismic shifts in the global order. I want to be more specific. How much of what you're seeing in bond markets in the United States, and I'm talking about treasuries as well as investment-grade corporate credit, is being driven by foreign selling versus basis trades being unwound in a sell what you can, not what you want kind of dynamic?
Yeah, I think at the moment it's, again, I think kind of hard to say or too soon to say. I think there's certainly a reduction of foreign demand. And I think that would not necessarily even, you have to classify that as selling. I think that's, a broader function of there's greater uncertainty around the U.S. You have banks, including our own, ourselves at Morgan Stanley, don't think the Fed is going to cut rates as much as the market expects. That's a challenge to bond markets, or that can be a challenge to bond markets. But also more broadly, right, if we are talking about reducing the trade deficit that the U.S. has with other countries, axiomatically, that means less demand from those countries for U.S. financial assets. That's just kind of the economic math. And so, again, I think there are a couple of different channels and a couple of different explanations that can be going on here. I think it's difficult, or I don't think it's helpful to kind of try to fixate on one particular result before we know for sure. But I think what we can see it as a broader pattern And unfortunately, I think a pattern you see during bear markets where investors are selling what they can, they're selling what is still up, and kind of treasury bond prices are still up, bond prices are still up, and they're trying to get overall exposures down. And I think that, kind of factors across a number of different markets, including credit markets, of what we're seeing.
If the Fed were to cut rates, would that help the issue or would that hurt the issue?
So I think that's a great question, because I don't think Fed cuts are necessarily the help that the investors might be hoping for. So one is, in what conditions would the Fed cut? Well, if we have a fantastic CPI number this week, and if we have very good inflation readings in the Fed cuts, I think the market would like that. But if we saw very bad data and the Fed is cutting, I think if you go back through history and you have a scenario where the Fed is cutting and cutting a reasonable amount with bad data, those are usually markets where you want to be selling into those markets, not buying. That's usually a sign that the economy is weakening, and Fed cuts are somewhat lagging that weakness. There's also, I think, a real question of, can Fed cuts really address this issue? I think the market is looking for the Fed to intervene here. But if the issue is trade uncertainty, does a 25 basis point cut offset, 104% tariffs on China for a business? That's unclear. And it also, the fact that these tariffs can change very quickly is a further challenge to the Fed. And I think a reason why we think, again, they'll be more measured, and they have a dual mandate. They're currently doing much better on the jobs part of their mandate than the inflation part of their mandate. And so we think at Morgan Stanley, that's a reason why they are going to stay on hold under our base case and ultimately, ease somewhat less than the market's expecting.
Andrew, if we're having great difficulty pricing the risk-free asset, what does it mean for everything else? How difficult is it right now to price credit?
So I do think it's, it is a challenge, but I do think it's interesting that credit is a real follower here. And I do think the credit market gets a reputation, maybe well-earned, of being this leading indicator, of being this canary in the coal mine. But I think what's really notable about this sell-off has been that credit was relatively slow to react to it. And I think for good reasons. I think the micro dynamics in the credit market were not really the problem in this cycle. You didn't have excessive loan growth. Balance sheets were in pretty good shape. You didn't have excessive levels of M&A activity. So, credit has not been at the leading edge. I think the credit market is very much following what's happening at other markets. But I do think you have this broader issue that if we think about an environment where growth is weakening, where the Fed might not react as quickly as the market hopes, where there's trade uncertainty, I could say that has a number of echoes to the fourth quarter of 2018, where Trump was president, where Jay Powell was chair of the Federal Reserve. And valuations in credit are still well short of the wides that we hit during the fourth quarter of 2018. And that was ultimately an environment where there was no recession. And that was an environment where a lot of the inflation readings were lower than today. So again, I think we're looking for various kind of waypoints or anchoring points that we can use in valuations in this uncertain period. We do think the fourth quarter of 18 is an interesting one, a useful one, but unfortunately we're not there yet.
Andrew, appreciate your time. Thank you, sir. Andrew Sheets there of Morgan Stanley. We all remember that December. High yield spreads gapped out really wide, just like that bank. And what we saw from the issuers is they were all pushed to the sideline, and that unnerved the Federal Reserve. You mentioned the 10-year issue coming from the Treasury a little bit later. Never mind corporate issuers. It's sovereign issuers that is the focus this time around.
Especially because primary dealers had to take down the greatest amount of 3-year debt sold yesterday, going back more than a year. Again, a real plain vanilla, non-controversial issuance. Look, there is a real question of volatility in the benchmark bond, what that does going forward, why that is happening. Nonetheless, there is a real question about what the Fed can do to really stave that off, given that there are inflation concerns that we're not in the boat when we talked about what happened in 2018.
Rate cuts can't produce Chinese exports.
Rate cuts can't control the long end right now at a time where 2-year inflation expectations are rising.
Bond yields are up right now by 8 or 9 basis points across the curve. The 10-year at the moment just short of 440. Equities are settling down. On the S&P 500, we are negative by about 0.4%. But the kind of price action you've seen over the past few days, consistent with the kind of price action you see in bear markets. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. President Trump's reciprocal tariffs are in effect, including 20% levies against the EU and a historic 104% 20% tariff on China. That follows a 10% baseline tariffs for most U.S. trading partners that took effect on Sunday. So far, Asian countries, including Cambodia and Vietnam, bearing the brunt of the measures. China's top leaders reportedly plan to meet as soon as today to discuss measures to boost the economy and stabilize capital markets. China did not immediately respond to the new U.S. tariffs, unlike the last two episodes, when Beijing retaliated within minutes. Elon Musk attacking White House Trade Counsel Peter Navarro as President Trump's tariffs roll out. Musk calling Navarro, quote, truly a moron and dumber than a sack of bricks in a series of X posts as a spat between the two continues. Navarro going on to say Elon is a car assembler. He's a car person. That's what he does. And that's your brief. John.
Hey, Danny, thank you. Appreciate it. More from Danny later this hour. Up next on the program, upending global trade.
I really think we're helped a lot by the tariff situation that's going on, which is a good situation, not a bad. It's great. It's going to be legendary. You watch. They've ripped us off left and right. But now it's our turn to do the ripping.
The market moves have been legendary. Matt Gertken of BCA Research joins us next, live from New York City this morning. Good morning. Close below 5K on the S&P 500 for the first time since April 2024. Equity futures this morning continue to decline. We're down by 0.5% on the S&P. Later this hour, earnings season begins with Delta Airlines. Delta, since April 2nd, down 17%. And so far this year, lower by 41. This morning, we're down by 1.5. Those numbers drop in the next 20 minutes or so. Under surveillance this morning, upending global trade.
I really think we're helped a lot by the tariff situation that's going on, which is a good situation, not a bad. It's great. It's going to be legendary. You watch. Legendary in a positive way, I have to say. We're making a fortune with tariffs. $2 billion a day. Do you believe it? They've ripped us off left and right. But now it's our turn to do the ripping. That's okay. We're going to make our country even stronger than it ever was.
So here's the latest this morning. President Trump's so-called reciprocal tariffs taking effect. The move raising tariffs to their highest level in more than a century. Levies pushed to 104% on China and 20% on the EU. Bloomberg's Ollie Crook joins us now from Brussels for more. Ollie, we're waiting for China's response. What's Europe's?
Yeah, we're going to get a response from the Europeans a little bit later today. But mind you, John, this is not a response to the tariffs that were imposed today, the 20% on European goods. This is in response to the aluminum and steel tariffs that we got a couple of weeks ago. And what we are expecting is a fairly narrow response from the EU. Remember, they want to keep as much runway open to have these negotiations with Donald Trump. It's going to focus on a number of different goods from the United States, some agriculture, some poultry, boats, motorcycles, those sorts of things, but only about $20 billion worth of goods. We should say this is a $1 trillion trading relationship. And when we think about the trade that happened last year, the EU was the biggest exporter to the United States to the tune of about 500 billion euros. You take 20% of that, that's 100 billion euros that today is trying to find out who is going to pay for it. It's going to be some of the producers here in Europe. It's going to be some of the consumers over in the United States. And as far as the Europeans are concerned, next week is when they will begin to get the architecture of how they could potentially respond to these 20% tariffs. This is where we get into the conversation about possible taxes to the tech firms of the United States, possible taxes on services, maybe regulations. But again, at the end of the day, the Europeans do not want to impose any tariffs. They want to negotiate a solution. And potentially Giorgia Meloni, who heads to the White House next week, will begin to try to get some information from Donald Trump for what the United States wants. We should also say, though, John, at the same time, we have Pedro Sanchez, the Prime Minister of Spain, who's on his way to Beijing. He will arrive on Friday, and he is talking about getting the relationship closer from the EU to the Chinese in response to the instability and the sort of unstable partnership to the United States. So the politics also very active here, John.
Ollie Crook, thank you, sir. Bloomberg's Ollie Crook there. Breaking down the negotiations versus the prospect of retaliation in Europe. We're breaking down the commodity market as well. Brent crude at the moment down by close to 5%. It's a break of 60 for the first time since 2021. Brent crude at the moment 59 87. The supply side response is in focus too. OPEC Plus bringing more crude online, but it's the demand side story here, Annmarie, that catches the eye.
Absolutely. If trade is breaking down, then those particles, oil used for trade, also going to break down, on top of the fact that you did have Saudi Arabia and OPEC Plus come out, not just say we're going to put more barrels on the market, but adding even more than they were subject to. I will have to say, though, this is probably a headline, Jonathan, that Donald Trump is going to tout and say, look, as I told you, oil prices are down, which means gasoline prices will come down.
I'm not sure crude's down for good reasons, but yes, they might talk about this headline. We're down 5% on WTI, 56.59. Joining us now to talk about negotiations and the prospect of retaliation, Matt Gertken of BCA Research. Matt, welcome to the programme, sir. We're waiting for the response from China. What do you anticipate happens next?
Hi, well, thank you. It's great to be with you. I think the main thing that's going on here is that the United States is recognizing, and the Trump administration will be forced to recognize by the financial markets and the risk of inducing a recession, that the U.S. cannot wage a trade war against the rest of the world all at the same time. It's bad strategy. It will induce a recession, and so it'll destroy the Republican Party in the midterm elections. That means the administration will have to backpedal on particularly finding small countries and then major allies that are willing to negotiate quickly, and then they can give them exemptions and exceptions to the tariff implementation. But meanwhile, they will maintain a pretty tough line with China, and we're seeing that. And China has been willing and ready to embrace this trade fight because China is also looking to divorce its economy from the American. And that's probably primarily because of strategic reasons.
Matt, this 104% tariff on Chinese goods, does this basically end, especially for small goods, trade between the U.S. and China?
Well, in a way it does. But the thing is that, of course, it can still be negotiated. Now, obviously, the odds of a phase 2 trade deal are low and falling. But we do have 3.5 years or more, really more, of the Trump administration still continuing this trade fight. And the correct strategy from the U.S. is to isolate China. This is where there's more popular support for taking trade actions, and to reduce the trade war elsewhere. And in that case, then we would have to see China actually come to the table in order to try to see the last pillar of its economic growth, which continues to be manufacturing, not destroyed by the Trump administration.
What do you think China's response will be? I know that there's some very influential individuals putting out on social media things like maybe banning Hollywood or not accepting U.S. poultry. What do you expect Beijing to do?
Yeah, well, those two retaliation points are perfectly valid and likely to happen. The truth is that the iPhone was already getting squeezed out of market share in China. Teslas were already getting squeezed out of market share in China. China's been very competitive building electric vehicles. Basically, American companies weren't getting access to China, and that's one of the reasons we have a trade war. China's overproducing goods. Now, of course, the Americans are overconsuming goods, but the point is that if there isn't a lot of market access for the U.S., then there's not as many great options for China to retaliate. If they try to sell treasuries, then the issue there is that it worsens the global economy, and then will retaliate. It will reflect or redound negatively on the Chinese economy. And also the Federal Reserve can buy those treasuries in an emergency. And so there's not a lot of great retaliation, but it definitely does mean squeezing out American goods and services, pressuring companies, using non-tariff barriers, and pivoting to the rest of the world and trying to build better relationships elsewhere.
They could lean on the FX channel. What are your thoughts on that? Could a trade war become a currency war?
Well, it certainly can. And that's been something in history we've seen. And of course, we've seen a depreciation in the renminbi since the election. And now we have signs that it's happening again. Now, that is, of course, poking the bear in the eye. If China's response here immediately is to depreciate the renminbi sharply, and it could, they could lower it, 5% or more, then this is basically another example where the Trump administration is going to have to come out and say they made the wrong choice, and they're going to have to threaten more retaliation. Now, ultimately, given that we're already at, well, you say 104%, really it's higher if you include the level of tariffs beforehand. Maybe the Trump administration doesn't have to do that much more on the tariff level, but they can simply threaten to keep those tariffs in place for longer. But definitely that puts deflationary pressure on other, or devaluative pressure on other currencies around Asia. And so it reduces the buying power of the world, and it reduces global growth.
Hey, Matt, appreciate your thoughts. Matt Gertken there of BCA Research on the potential of China to retaliate or to negotiate for that matter. Got to be across so many things this morning. In the commodity market, just briefly, a break below 60 on Brent for the first time since February 2021. In just a moment, earnings season starts with Delta Airlines. How can you provide guidance in a moment like this one? We'll get a view on the economy with Rob Sockin of Citi in just a second. From New York City, this is Bloomberg. It's another busy morning. Good morning to you all. In just a moment, we should get numbers from Delta Airlines, so stay tuned for that. Equity futures on the S&P negative by 0.75% on the S&P 500 following a close below 5K for the first time since April 2024. The wild swings we've seen over the past few days are consistent with a bear market. Futures on Monday, the lows negative 5%, the highs plus 3. On Tuesday, negative 0.5 versus plus 4 by mid-afternoon. Just amazing swings in the market. Elsewhere in the bond market, just to get to bonds, and then we'll turn to Delta. 2-year, 10-year, 30-year yields are still climbing. Up 10 on 10s, up 10 on 30s. Your 30-year yield approaching 5%, 4.86. Earnings season begins. How can you provide guidance in a moment like this one with Delta Airlines? Here's Danny Berger. Hey, Danny.
Hey, John. We have the new playbook for reporting earnings in a tariff regime. Delta is not giving an outlook. It has withdrawn its full-year financial guidance. It says that it will give an updated outlook later in the year when it has more visibility improvements. It still is anticipating a profit in 2025, but it is declining to give an exact figure or back the one that it gave earlier this year. Here's also another sign in just how much companies are willing to spend. Delta planning to trim its capital expenditures for the rest of the year. It now expects no growth in flying capacity for the second half of the year. The CEO saying that growth has largely stalled with the trade uncertainty. Again, not affirming their full year growth given the current uncertainty. For what it's worth, for the first quarter, they did beat 46 cents a share. That is a beat of the average analyst estimate. But remember, that was already a downgraded view given from March when they said that they were concerned about domestic consumers and their likelihood to fly. They did give an outlook for the second quarter. They said that earnings would be as high as $2.30. That is slightly above expectations. But John, the big headline takeaway, uncertainty means no guidance from Delta.
Danny, stay close. They're not going to be alone, that's for sure. I imagine you'll see many more headlines like the one we just saw from Delta Airlines. Remember, Delta, the first to come out in the first quarter and warn about what was happening with consumer activity. That in the middle of February, things started to stall. It looks like they've continued to stall. Understatement of the year so far. The first quarter unfolded differently than initially expected. Lisa, I imagine you'll hear a lot more in a similar vein in the coming days and weeks.
Yeah, I mean, if Delta sneezes, does the rest of the airline industry catch a cold? This is one thing that Ed Bastian, the CEO of Delta, did say, while the first quarter unfolded differently than initially expected, we delivered solid profitability that was flat to prior year and this is the key point, is expected to lead the industry. So if Delta cannot give some sort of sense of what kind of guidance they have ahead, how can American Airlines, United, let alone Southwest and JetBlue? This is a big question mark. And how do they exactly plan for capacity as well as staffing?
Well, Danny, just to bring you back into the conversation, that capacity issue is really important. Delta's not just going to sit there and do nothing. They are telling us what they're going to do in the coming months.
They are. Look, this is a company that has now decided that they're going to be trimming capital expenditures, and it doesn't expect growth in flying capacity for the second half of the year. In a way, it might be good because we might be experiencing some supply issues for the airlines. You have to remember that airline supplies is a global business. We've already heard from the likes of over the weekend, reports from Reuters that Howmet, one of the suppliers for parts for airplanes, declaring a force majeure. So you have both the demand and the supply side under constraint. So maybe it makes sense that they're not going to be expanding capacity with all of those various headwinds coming their way.
Danny, thank you. Delta Airlines pulling guidance. We'll get more guidance later on this week, or lack thereof, from the banks when they report on Friday. JP Morgan kicking off bank earnings on Wall Street. Speaking of capacity, Lisa, Virgin Airlines, Virgin Atlantic, set to reduce winter flights to JFK. We saw that announcement in the last 24 hours as well.
Yeah, and we've seen this type of capacity withdrawal. It's not clear that they have the ability to really cut prices to try to induce people to come to buy if they have higher costs across the board, maybe not gasoline, but certainly with other costs that are coming in. A big question mark is also international demand, because so far they said it is holding up, but there's a real question about how much inbound demand there is to come to the U.S., and especially if the dollar is weakening, how much outbound demand there will be from U.S. Consumers dealing with the wealth effect and maybe dealing with that Italian vacation that isn't quite as cheap.
Just to sit on international, if you watch Secretary Bessent sitting down with Tucker Carlson over the last week or so, I think he did a fantastic job of articulating the kind of things they're concerned about. The last summer, you saw record European travel from Americans. At the same time, you saw record usage of food banks in America. This is something that's on their radar big time down in Washington, D.C.
Look, there is a sort of discussion around the people who are most upset right now are the people who have benefited from some of the order that we have seen over the past 10 years that really culminated in the post-pandemic era. There are many legitimate criticisms in the way things have been arranged. Question is this the way to get about rearranging that, number one? And number two, does it lead to ultimately a more profitable backdrop? Right now, consumers and frankly, corporate America is not so sure.
For the underlying economy, in the meantime, the low-income consumer has been squeezed now for 5 years. They've been under massive pressure. The high-income consumer is the reason why these numbers have been okay at the headline level. That's what speaks to Delta Airlines and the whole industry right now. You mentioned international, long-haul and premium. Is long-haul and premium starting to break? Because if long-haul and premium is starting to break, then I think there's a read-through to the broader economy from there.
This has been the consumer that's held up the rest of the economy. It has been the wealthiest consumer, the ones that have benefited from the wealth effect, from the fact that stock markets have risen dramatically. All of a sudden, if you lose 20% like that in just a couple of trading sessions, how much does that dampen demand for luxury goods? We've heard some warnings from analysts covering the luxury goods sector. Airlines are going to lead this, given their dependence on that premium product.
Tons of volatility in the equity market. Delta right now is negative by about 0.5% in the pre-market. To turn to the global economy, Robert Sockin of Citi writing, for this year, global growth now looks likely to fall in the 2 to 2.5% range and could fall below 2% if downside risks materialise, particularly for the US and China. Rob joins us now for more. Rob, good morning.
Morning.
Is downside risk materialising?
I think what we're seeing this morning with another 50% on tariffs, I would put that heavily in the downside risk category. That is not only going to weigh on growth in China, growth in the U.S., spillovers to other regions. But we have to start thinking with tariffs that large, do we start to get even non-linear effects where trade drops off very sharply because it's uneconomical at these levels? So I'm worried with the way things are moving that we could get even lower than those numbers. I would say if those tariffs stick, I would be in the high 1% for global growth, but with significant downside risk.
That if. How much heavy lifting is that if doing right now? Why are we still sitting here saying if they stick?
Yeah, it's doing a lot of heavy lifting. And the only reason I'm using if is because these numbers are so large that maybe it does bring the two sides to the table, because the economic damage is not just felt in China. It's felt in the U.S. from these tariffs. And more broadly, actually, when we do our modeling, because we're tariffing all of our trade across countries, the economic damage to the U.S. from these tariffs is generally found to be larger than it is for the rest of the world. China's an exception because the tariffs are so exceptionally high there. But broadly speaking, this is hurting the U.S., I think, most of all, at least in the short run.
There seems to be some dissonance right now between economists on Wall Street who are saying this is a five-alarm fire that could potentially torpedo the global economy, and even companies that are coming out and saying, look, we don't know. And honestly, we do see consumer demand sticking in for the most part. Maybe there are some deteriorations on the margins. How do you square those two gaps? Is it just a time lapse as these things come into effect? Or is it just that generally Wall Street economists are portraying the worst case scenario to say, look, this is what could happen versus what is happening or what is likely to happen?
Yeah, absolutely. And, as economists, we have to think about all sorts of things like how durable these tariffs are, how long they stay in place, what the drag from them is. And consumers and businesses have to think about the same thing. But so far, I think the effects on behavior aren't seen as much because this has come as a large shock. And I think if they stay in place, you're going to start to see a more substantial pullback. When we look at polling of surveys of businesses and consumers, you're seeing a sharp fall in sentiment across the board, even if activity hasn't fallen yet. That tells me that, all right, activity is holding up okay now, but you could see a sharp pullback going forward if these risks that we've been talking about, these tariffs stay in place, do actually materialize.
Will it lead to some sort of layoff wave if this does continue, if these tariffs do stick, given the fact that companies are scarred by what happened during the pandemic? They are very aware of demographic issues, and we have less immigration, so that's going to also restrain the pool of workers that they have to hire from.
Yeah, absolutely. Those are great points. And I would first highlight that the labor market and the consumer have been remarkably resilient through the cycle. So we shouldn't underestimate that resilience as we go into this additional shock. That being said, with the way these numbers are moving and with signs that households are showing increasing stress, we're talking about the lower income consumers that have shown stress, those stress are going to worsen if inflation picks up. And upper income households potentially, which we haven't worried about throughout the cycle, have that worry about that negative wealth effect from the fall in equities. So I think consumers are likely to pull back. And on top of that, companies are going to have to find ways to be profit maximizing in this environment where their costs have gone up so much. That could mean layoffs. So the combination of slowing consumer spending and the need to preserve costs, I think we have to worry about the stability of the labor market.
If the tariffs stay long term, is the rate so high that it actually would make economic sense for businesses to come back and manufacture in America?
And if you're going to take the administration at face value for the economics, that's what they're trying to do. They said this will be short-term pain, but it'll be long-term gain. And what I worry there is twofold. One, there's a time disconnect that even if companies say, all right, we're going to come back and produce America, it's a long time span between when that gets announced and when it happens. And in the meantime, the tariffs in place. The second worry I have is there are many industries where we don't produce much of those products in America. And when we talk to companies, it's not quite clear we have the infrastructure to produce them here. Apparel is a very good example where we produce very little in the U.S. So there's a question of, can industries that have moved overseas, some of these examples, could they be viable in a U.S. model? And there's a big question mark there as well.
Yesterday, the president in the morning was talking about getting on the phone with some world leaders like South Korea. It felt like there was opening to negotiations. By the evening, he was talking about really doubling down, saying, I'm going to even add pharmaceutical tariffs on top of this. Do you have a base case on any of this by the end of the year where rates could be? Yeah, well, we hope, the way we've been framing is kind of the peak tariff rate, because we do hope that we end up in negotiations, these start to come down. We were at a peak tariff rate of kind of 25 to 30% range before this 50% announcement. This takes you close to 30%, especially if we get some of those sectoral tariffs, which we do expect on things like pharmaceuticals. I do hope after that we move into a period of negotiations. And as we're saying, with China, it's pretty tense, and maybe that could take a lot longer. Who knows where that could go? But hopefully with some of the other countries, we start to get negotiations. However, the administration's talking tough. They're saying they're looking for great deals. Yeah. And that says to me that it could be months until these come off rather than days.
Rob, we're going to hear that word repeatedly through the next week. And to your point, this could go on for months. That word hope right now is the problem. Not to be too dark. Hope is the problem, and I'll tell you why. For as long as we sit here and say, are these the rules of the game? Or can we negotiate? Companies will do nothing. In fact, they'll do less. They won't be building the factory, because if they don't believe the tariffs are actually going to hold, why would they start making plans to build the factory and boost capacity in the United States? Lisa, that's the issue you've got in the near to medium term at the moment, and that speaks to Delta Airlines again this morning. What is Delta doing? They're reducing capacity. Now, I know that's a very unique story for the airline business, but are you going to see other businesses do the same? The opposite of what the administration would like to see, because we're stuck in the hope game. We're sitting here every single morning saying, are these the rules of the game? Or can you negotiate? If you don't believe they're the rules of the game, if you keep sitting here and saying, I hope they will come off, if they stay on, you're not going to come out with big plans for CapEx anytime soon.
Factories are being idled people actually on the margins have been laid off from factories that are on pause until people have greater sense of certainty. What we've seen, to your point, is exactly the opposite. And inaction is action. And what we're seeing is companies not deciding to do CapEx pretty much across the board. They are not deciding to purchase other companies. So at what point does this become a self-fulfilling prophecy?
Robert Sockin of Citi. Robert, it's good to see you, sir.
Pleasure.
Thank you very much. This came from the central bank governor of Spain just moments ago in the Financial Times. Some of the worst-case scenarios that we had identified are materializing. That's the situation we're in right now. Equity futures on the S&P 500 down by about 0.7%. Wild swings over the past few days. Let's get you an update on stories elsewhere. With your Bloomberg Brief, here's Danny Berger. Hey, Danny.
Hey, John. Just to recap those Delta earnings with shares in the pre-market up nearly 3%. It withdrew its full-year financial guidance, citing uncertainty surrounding global trade. Delta also said it will update the outlook later in the year as visibility improves. CEO at Bastion told Bloomberg that confidence is dimming, growth is stalling, and revenue has flatlined. President Trump signaled measures to promote the use of coal in the U.S., aiming to revive the fossil fuel industry and power data centers. The initiatives include legal strikes against state regulations and efforts to accelerate coal exports and develop coal technologies. Elsewhere in Germany, conservatives and social democrats have reached an agreement to form a ruling coalition that paves the way for Friedrich Merz to become chancellor. A deal is set to be announced later today, but it still must be approved by members of the Social Democrats. Merz will likely succeed Olaf Scholz as chancellor in the first week of May. And that's your brief, John.
Hey, Danny, thank you. Great work as always. More from Danny a little bit later in the next hour. Up next on the program, dollar assets in question.
Because we have these great worries over U.S. policy, they have brought into question the role of the U.S. and it's brought into question the role of the dollar in the global system. In this market narrative around a broad reallocation away from U.S. assets, and that in turn putting pressure on the dollar.
Up next on the program, we'll catch up with Alexander Jekov of BNP Paribas, live from New York City this morning. You're watching Bloomberg TV. Close on the S&P 500 south of 5K just yesterday for the first time going back to April of last year. This morning, futures a touch softer, down 0.25%. Is this the playbook for earnings season? Pull your guidance. That's exactly what Delta Airlines did about 20 minutes ago. That stock, Lisa, higher by 3% in the pre-market.
They actually performed better than expected on the margins in the first quarter, and this actually does speak to their ability to be the front runner from all airlines. The fact that they're going to be cutting capacity highlights maybe their ability to keep prices high and even increase them further at a time when all of the industry is going to be feeling the same pressure.
More earnings coming through the week. You'll get the big banks on Friday, starting with JP Morgan and a whole lot more. Under surveillance this morning, dollar assets in question.
Because we have these great worries over U.S. policy, they have brought into question the role of the U.S. and it's brought into question the role of the dollar in the global system. In this market narrative around a broad reallocation away from U.S. assets, and that in turn putting pressure on the dollar. This is also not the first time that the market has falsely gotten excited about this narrative and it wasn't sustainable. Even if it is the start of a massive rotation, that's something that will take a decade or more to play out.
So here's the latest this morning. The US dollar pulling back as President Trump's so-called reciprocal tariffs take effect. China holding fire on immediate retaliation. Alexander Jekov of BNP Paribas writing, the market is trading rotation out of US assets, making universal tariffs potentially bearish for the US dollar. Alexander joins us now for more. Alex, good morning. It's good to see you.
Good morning.
Let's start on that call. Things have changed. We started the year and a lot of people thought tariffs up, dollar stronger. Tariffs up, dollar weaker. What has changed?
Exactly as you say, a lot has changed. The market's gone from trading tariffs as dollar bullish because FX was the offsetting factor for tariffs to now treating them as dollar bearish because the market's focused on a rotation out of US assets. I think what's changed is previously the market was looking at unilateral tariffs. Now the market is facing universal tariffs, and universal tariffs are more growth negative for the US. What's key for FX is that foreign investors are particularly overweight US equities because of the valuation adjustment that we've had in the last 10 years or so. And that makes FX more sensitive to this rotation.
That dollar long has accumulated over the best part of a decade plus. Do you see a real structural shift emerging here?
Yes, we do. So part of that, of course, is the tariff narrative, but part of that is also about Eurozone fiscal reform. We think Eurodollar can get to 120 by the end of next year on the basis that Eurozone fiscal reform is a game changer. It means structurally higher bond yields. It means structurally higher growth. And for FX, it also means that the higher supply can crowd in European investors. In other words, less of an outflow. So it's not just about the equity rotation that we just spoke about. It's also about a crowding into domestic fixed income markets.
Is the rumor a bit more inflated than maybe the reality, though? I mean, if we're talking about increasing defense spending in Europe, how much is that actually going to boost growth in a way beyond what we've already seen?
Yeah, so before these tariffs were enacted, we were looking for about a 0.4% change or so to growth this year. So not immaterial. And a lot of that comes from the confidence channel. Later, as Germany sort of potentially builds out its defense industry, there are other channels. We do think it's game-changing over the medium term, but it's a sort of sequence. In the near term, if tariffs are here to stay, then that offsets some of the fiscal impact. But in the coming years, and I think that's ultimately what the FX market's going to be looking at, it's a bullish factor for the euro.
What has changed since late last year when everyone said that tariffs unabashedly would be worse for the rest of the world than the United States, that suddenly that entire narrative has gotten completely flipped on its head?
I think it's the universal tariffs. Universal tariffs are more growth negative for the US. I think the paradigm that we're in for Eurodollar specifically is not too dissimilar to the one we're in 2017. When Eurodollar rallied from 105 to 125, in spite of front-end rates moving 100 basis points against the pair. This time we could see something similar if the Fed, for example, keep rates on hold, as we expect them to in the near term, given the focus on inflation, where FX then, rather than focusing on rates, starts to focus on global asset reallocation.
What's the safe haven now? I see the Swiss franc money pouring into that currency this morning, but they're being hit with a 31% tariff, even higher than the European Union. Yeah. And Trump last night is talking about hitting pharmaceuticals, which is a main industry that they export.
I think you can make a bearish case for the Swiss franc still. You can say, for example, the SNB are a dovish central bank. And as you rightly point out, tariffs on Switzerland are not immaterial either. But the way in which we think about it is when you have a big risk off, it's very hard to fight the inflow into Swiss. So it is still a safe haven. It might not be the best safe haven. So for example, yen, we ultimately expect to perform better than Swiss over the medium term. But I think in a big risk off, those factors like what are the tariffs on Switzerland or what is the SNB doing sort of move to the background for the market.
You're focused on the European story. Can we just throw some China in there just briefly to finish the conversation? Do you see a potential for this to morph into a currency war from a trade war? Or are these tariffs just so large, so big that any kind of devaluation on the side is just kind of doing things around the edges?
I think that it'll be very difficult for the FX to offset the extent to which these tariffs have been enacted or the extent to which or how large these tariffs are. Ultimately, we have a more bearish view on Asia FX because that's where the real surprise came last week. Right? People were, or I would say investors were likely already expecting tariffs on Europe, but definitely not to the extent that we've seen them on Asia FX. And so we think the euro can do well, not just versus the dollar, but also versus the Asian FX complex, and CNH is part of that. So euro CNH, although it is already at very high levels, we think risks are still to the top side.
Surprising to see such large numbers on places like Vietnam. And I'm sure a lot of US-based companies were very upset to see that just last week.
Yeah, which raises the question, at what point do they push back? And are we going to hear that in guidance? I would take that a step further. If universal tariffs hurt the U.S. more than the rest of the world, at what point do potential deals offset that? Or is the sort of cat out of the bag and we can't really put it back in, genie out of the bottle, whatever kind of analogy you want to put.
Toothpaste out of the tube.
Thank you. That's perfect. And it's hard to really reset this clock.
Can I mention another French bank? Forgive me, Sockin came out with this morning. Very competitive, the two. Slapping 104% tariffs essentially means China's exports to the US will largely be wiped out. The scale of tariffs is simply too large for any exporters or consumers to swallow. The FX channel is not going to change that story with 104% tariffs on.
This is ultimately going to be a story of either negotiation or a cessation of trade. or potentially consumers paying a lot more. And that's basically where we're at.
Alex, good to see you, sir. Thanks for dropping by. Appreciate it. Alexander Jekov there of BNP Paribas. Up next on the programme, Chris Harvey of Wells Fargo, Bloomberg's Tyler Kendall, Sheila Kahyaoglu of Jefferies and Tony Rodriguez of Nuveen. From New York City this morning, good morning to you all. The second hour of Bloomberg Surveillance. Up next.
You're in wait-and-see mode. Those are the three most dangerous words.
We thought that last week would be the week of peak uncertainty. It was not.
We could be in for a long period of pain here.
The critical thing is to what extent investors really start to fully price a recession.
What ends a market cycle is an oncoming recession, an uncooperative Fed, or bond yields moving higher.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning to you all. The second hour of Bloomberg Surveillance starts right now, and your scores look like this. On the S&P 500, futures are lower. We're down across the board. Wild swings over the past few days, and they continue. Gapping lower by 1.2% on the S&P 500. On the Nasdaq, we're down by 0.9. The focus now shifts to corporate America. Delta Airlines out just 30 minutes ago. In a few days' time, we'll hear from the big banks. Delta's up by more than 3%, and Delta doing what I imagine many others will do. Pulling guidance, Lisa, this morning.
They're pulling guidance at a time where they basically say, how can we have any certainty whatsoever? They say they are watching closely their premium content, as you were mentioning before, John, because that has been fueling a lot of their gains. But they do plan on trimming capital expenditures. This is important. They also are expecting no growth in flying capacity for the second half of this year. So it's not just no action. They are battening down the hatches, and they are preparing for potentially a bout of volatility.
We're expecting more still to come on this front from other companies in corporate America, but just crossing the Bloomberg terminal, Walmart's a very different beast. Walmart this morning, Lisa, reaffirming their guidance for the months ahead.
And they're going to have a much different story to tell when it comes to how they're negotiating the pass-throughs and how much they can pass along to the consumer. Nonetheless, they said that full year 2026 guidance remains unchanged, with first quarter sales up 3% to 4%. So not necessarily the same kind of flavor as we're hearing from Delta. Interesting to see that Levi's said the same thing. So at what point will the guidance that we're getting from corporate America be a lot more positive than some of the gloom and the doom of the projections of economists on Wall Street? This is the contradiction, the past and the present versus the potential projection of the future.
This pendulum keeps swinging between deal hopes and tariff threats, and that continues this morning, depending on who you speak to. Your day ahead looks like this. A couple of things to watch for. Busy morning coming up. You'll hear from Secretary Bessent a little bit later on this morning. 8:30 Eastern Time. After that, he'll be very focused on this number, $39 billion of 10-year notes coming to market at a time when 10-year bond yields are higher, not lower. We're up 8 basis points at the moment to 437. Someone else speaks a little bit later as well, Anne-Marie. Jamieson Greer on Capitol Hill, day 2 for the U.S. Trade Representative.
This is going to be very important. He spoke yesterday at the Senate, and that's when you saw Republicans come out, notably Senator Tom Tillis. Whose throat do I choke if this proves to be wrong? Republicans are starting to get nervous. What you heard from Ambassador Greer is that the middle class has been decimated when it comes to the so-called China shock, and they are excited about this being one of the biggest trade actions we have seen since China joined the WTO. But you have to imagine, given the market reaction this morning, and that 104% went on China, and remind you, it's even more for goods that are hit with 301 from Trump 1.0, north of 120%. He is going to get a lot of questions.
I mentioned equities were gapping lower. We're down by 1.7% on the S&P 500. There is a why. So let's get to that why. This headline just crossing the Bloomberg terminal that China is raising tariffs on U.S. goods to 84%. So overnight, we moved to triple digits on the U.S. side. We sit here this morning waiting for retaliation, a response from China. And Lisa, we get it. It's 84%.
So this raises the pressure that much more. Initially, there were reports that maybe the reaction was much more muted from China. They were taking a wait-and-see approach after having more than 104% tariffs put on all their goods coming into the U.S. as of today. A real question here. How does President Trump respond? How much does this affect the current products that are sitting on the ocean waiting to get to the United States? And frankly, what does this relationship look like at a time where you already have seen a huge drop in the amount of trade between these two countries?
I think if you're in the market right now, you're wondering where to hide. And I can tell you at the moment, you can't hide in the bond market. It's not working. Yields are up now by double digits across the long end of the curve. On a 10-year up by 10 basis points. On a 30-year, higher by almost 12. Lisa, that auction later, let's sit on that. 10-year auction, supply coming later at 1 p.m. Eastern Time. You always make a big deal of it.
I do.
How much of a big deal is it today?
It's potentially massive because yesterday was not a good auction and it was an easy one. Today we have $39 billion of 10-year notes being sold at 1 p.m. Eastern at a time where consumers are not clearly going into these instruments as havens. Are banks going to have the capacity to take on the risk? Can they absorb demand if there aren't other investors that come onto the field? One thing I want to say, tomorrow it gets even hairier when we've got $20 billion of 30-year notes being auctioned. That is the note that has been most affected by potentially the basis trade unwind, but potentially also a whole host of other selling.
Still trying to figure that out.
Yeah.
That's for sure. Many of you are at home, I'm sure. If you're just joining us, welcome to the program. So your main headline this morning, as expected, the reciprocal tariffs go on. Just moments ago, getting confirmation from the Chinese side of things that China's raising tariffs on US goods to 84%. Equities gapping lower stateside, even more lower, much lower across Europe. The DAX, across France, across Italy, we're seeing losses across the continent. Coming up this hour, we'll catch up with Chris Harvey of Wells Fargo following another volatile trading day. Sheila, Kahyaoglu of Jefferies reacting to Delta earnings, and Tony Rodriguez of Nuveen as the bond market offers very little comfort. We begin this hour with stocks looking to snap a 4-day losing streak and struggling as another round of Trump tariffs kick in. Chris Harvey of Wells Fargo writing there's growing crisis of confidence brewing. Stock market vigilantes will not be that patient or ignored. It probably needs to get worse before it gets better. Chris joins us now for more. Chris, good morning. Good to see you.
Good to see you too.
This is a really difficult one. So let's take a beat. Typically, we sit here and think about the kind of threshold that it would take for a policymaker to step in and act as the circuit breaker. This time, the policymaker is the source of the risk, maybe not the solution. How different is this as a moment for you and the team?
It's very different. And the issue is, and we go back to Greenspan before the 04 tightening cycle. He said, we can raise rates, right? But what we need to do is we need to communicate that to you. We need to tell you how we're going to raise rates, over what time period, so you can plan. If you're going to buy a house, you can speed up that house purchase. If you're going to buy a car, you can speed that up. This administration is talking a lot, but they're not communicating a lot. This weekend, we had one person saying tariffs are negotiable. We had somebody else saying they're non-negotiable. What are they? What's your goal? What you're trying to do? What are we handicapping? Over what time period? You need to communicate better. The other thing is the market is sending a big signal. It's not a good idea to ignore that.
China's sending a big signal right now as well, so I'd love your thoughts on that too. Big tariffs coming from the US side overnight. China responding with 84%. I think at the moment for a lot of investors, they look at that headline and say, you know what, given how little we sell to China, that's not much of a big deal. But I think the bigger read across, the bigger read through at the moment, that makes it much harder to get to the negotiating table with this president who's pushed back against China, threatening to do exactly this.
Yeah, so what people have realized is the weak spot for the U.S. is the capital markets and the economy. If they push back, right, we're going to lose, and we are losing some negotiating leverage. What are we talking about? We're talking about recession. We're talking about job losses. We're talking about the negative wealth effect. We're talking in a recession, the deficit goes wider, not tighter, and people know that. So they're saying, okay, fine. If we're going to do this, we're just going to pull everyone down into the muck. And what you're seeing is just not great.
Well, I'm looking right now. China also added 6 more firms from the U.S. to the unreliable list at the same time that we've seen incredible losses in the likes of Apple, which seems to be very much in the crosshairs of this. How much does this discourage you from going to the multinational companies, actually at a time when they potentially could be the most exposed?
Yeah, Lisa, what we need to do is we need to figure out exactly what we're dealing with. And because it's a moving target, that's why it's so hard to, that's why the markets are so fluid at this point in time. And you're right, where are the safe havens? The safe havens are at the front end of the curve. Safe havens are in low vol, they're in defensives. But even those are still, that's a place where we've liked, but it's still showing some stress, right? So it's very difficult to find a safe haven. It's very difficult to really preserve your money or your assets at this point in time.
Yeah, the reason why is because 10-year yields are up through 4.40. You're looking at 30-year yields now almost 4.9%. Yeah. They've absolutely been surging. What's going on? I mean, what are you doing with this?
So there's lots of talk. One conversation is that out of Asia that they're selling duration, right? So they're selling longer bonds and buying shorter bonds for liquidity issues to send a message. There's other talk about basis trades. There's if you look at what's happening, nominals, last time I looked, Nominals are going higher, but it's being forced by reals. It's not being forced by, at least in the last couple of days, by inflation expectation. That seems more like a liquidity issue, people moving around positions, not so much fundamental driven, right? The other thing is, obviously, we've got issuance coming, and there's more and more fear, even though right now inflation expectations or break-evens aren't moving, there's fear that that will continue in the future.
Seeing some big moves right now, that's for sure. If you are just joining us, welcome to the program. 84% tariffs from China. China raising tariffs on US goods to 84%, and the spillover immediate. Equity futures down by 1.6% on the S&P 500, the Russell down by 2.5%, the DAX is down by 4 full percentage points, and in the commodity market, you're seeing crude roll over as well. On WTI and on Brent, we're down by 6%. Brent crude 58.98, WTI 55.85. There will be some individuals in America making a lot of noise today off the back of this headline. I'm thinking of the farmers in a few red states.
Absolutely, because remember, Trump 1.0, the farmers were the ones that got hit the worst because they didn't have the export market of China to go to, and then the United States had to bail them out. But Jonathan, you started this conversation this morning where you're looking to policy makers for the answers, for the solutions. When I asked the president directly the pain threshold he was willing to take on for the market, he said sometimes you have to take medicine to fix something. They think the tariffs are the medicine. Well, what's going to be the solution and the medicine to what is happening right now, the fallout from these tariffs?
Some big moves elsewhere as well. Apple's had a difficult run of things. That name is down by 2% in the pre-market at the moment. Apple is down before today by more than 20% in just 4 sessions. The worst run for that name going back to 2000. The year 2000, the worst 4-day run in 25 years for one of the biggest companies on the planet. Chris Harvey, not to talk about single names exclusively, but we can talk about Mag 7.
Right.
Are they in a difficult moment now, in a much, much bigger way than maybe we've ever seen for those names?
So some, yes, and obviously Apple is more of a focus because of the tariffs and what they manufacture in China, right? The rest of the Mag 7, more of the communication names, they're in a little bit better space, but it's not as if anyone's in great space. It's not as if you can say, wow, this is a perfect spot, this is fantastic for these guys, couldn't be any better. It's just relative, who's worse, who's better, and who's going to get hurt a little bit more. Where's the defensiveness? Right now, what we're doing is everything is across a risk spectrum, and which one has less risk. That's all you're doing.
What's on your dashboard at the moment to establish where a tradable bottom might be? Is that impossible right now for you and the team?
No. So John, this is what we're looking at, because we see a setup. We don't see the bottom, but we see a setup, right? We want to see 1Q numbers reset. We want to see them cut. We want to see an inversion in the front end of the curve between 2 years and Fed funds of 100 basis points or more. That tells us that the market's indicating we need to move faster, you need to hurry up, and potential monetary policies coming. In addition to that, we want to hear the conversation become more productive. We want it either to shift from tariffs to taxes, or the acknowledgement that, oh, yes, it's good. Everyone knows there's going to be pain. But the issue is they just don't know. The cure seems to be worse than the disease right now, or that's what the market's saying. You have to acknowledge that, hey, yes, there's going to be pain, but there's light at the end of the tunnel. Here's what we're doing. Here's our goals. When we get there, this is what's going to happen.
In the meantime, Delta withdrew its guidance for the full year. Walmart reaffirmed its guidance. What do you do with this?
So we actually had this conversation yesterday, and I've been having this conversation a lot. We expect numbers to come down. It's going to range. Some people, we were talking to our auto analyst, and he would not be surprised if there would be suspension of guidance there. We were talking to others saying, maybe it's going to be 5%, maybe 10%. What we're going to hear is the C-suite's going to say, out of an abundance of caution, here's what we're doing. We're lowering the top end of guidance. We're cutting 5%. We're cutting 10%. Because of the uncertainty, we have to remove guidance. So it's going to be right across the board. And you're right. The example of Walmart and Delta is a good one because you have the two ends of the spectrum.
Chris Harvey, going to stick with us, I'm pleased to say. What a morning already. Chris Harvey of Wells Fargo there. If you are just joining us, some big moves out of China, not just the United States. For an update on that and more, let's get your Bloomberg brief with Danny Berger. Hey, Danny.
John, let's get straight to the breaking news. China is raising tariffs on goods imported from the U.S. to 84%. It's a retaliation against a new 104% levy that President Trump imposed on the country. That, of course, according to a government statement. Now, the shares of large U.S. and European drug makers are sliding after President Donald Trump said the U.S. was planning to announce a major tariff on pharmaceuticals soon. Speaking to an event at the National Republican Congressional Committee, Trump said the tariffs will incentivize drug companies to move their operations to the U.S. Elsewhere, San Francisco Fed President Mary Daly says that the central bank can take its time before adjusting interest rates. Daly saying, quote, with good growth and policy in a good place, we've built the time and the ability just to tread slowly and tread carefully. And that's your brief. John.
Hey, Danny, thank you. Appreciate it. Big moves from China. Big moves in this equity market. Down 1.4% on the S&P. Up next, nerves building on Capitol Hill.
I'm assuming this all got gamed out because it's a novel approach. It needed to be thought out. Whose throat do I get to choke if this proves to be wrong?
Tyler Kendall will answer that one next. Live from New York City this morning. Good morning. Don't blink. You cannot look away from the Bloomberg terminal right now. Another headline. Overnight, big tariffs on China. The response, China raises tariffs on U.S. goods to 84%. The reaction, equities down across the board, negative 1% again on the S&P. In the bond market, no comfort there. Bond yields up by 8 basis points on 10s. In the commodity market, speaking to a deceleration in economic growth. Crude down across the board by more than 5%. It's a break of 60. On Brent crude, 59.33. Under surveillance this morning, nerves building on Capitol Hill.
In this scenario, the decision maker who decided the alla prima approach, who has obviously had to have spent time anticipating what we saw in the markets and some of the pushback, I'm assuming this all got gamed out because it's a novel approach. It needed to be thought out. Whose throat do I get to choke if this proves to be wrong?
Here's the latest this morning. President Trump's tariff rollout raising concerns for Republican lawmakers on Capitol Hill. Senator Ted Cruz also warning there could be a bloodbath in the midterms if tariffs push the economy into a recession. Bloomberg's Tyler Kendall joins us now for more. Tyler, welcome back. Is the pressure starting to build?
Yeah. Hey, John, it certainly does appear that some Republicans are starting to sound the alarm that these tariffs are a little bit more than they bargained for, although we are still seeing them kind of walk the line between criticizing the tariff policy itself versus the tariff rollout plan. And we should just note for quick context, as you well know, many of these congressional Republicans won the majorities in Congress by campaigning on that economic messaging. And some Republicans in some tight re-election races in 2026, like Senator Tillis, might feel like they don't have the benefit of an extra couple of years to see some of the potential policy benefits from these tariff plans. And as you mentioned earlier this hour, it's not necessarily new concerns from Republicans, particularly when it comes to potential impacts to farmers. And I went back and I checked my notes this morning because I had caught up with Senator Todd Young, a Republican from Indiana, after he questioned Treasury Secretary Scott Bessent during his confirmation hearing about how this White House would protect farmers. And at the time, he told me that he had assurances from this administration that tariffs would be targeted, except in some cases where they would be used as a negotiating tool. It is so clear, John, that we have blown past those expectations, not just of the market, but of these lawmakers who came out and had supported the tariff plans to begin with.
Tyler, today the big focus is going to be on China, I imagine, when Jamieson Greer sits down on the House side at 10 a.m. Yesterday, Trump claimed that China wants to make a deal, and he's waiting for Beijing's call. Any inference you're getting from the White House that she plans to call Donald Trump?
Well, at this point, Annmarie, we also have to note that there hasn't been a call between these leaders since President Trump was inaugurated. And we went from President Trump a couple of weeks ago saying that there could potentially be an in-person meeting between the two leaders. We saw Senator Steve Daines, another Republican who was questioning the USTR yesterday, travel to Beijing in a bid to try to make that potential meeting happen. And now we're, of course, at this broader escalation. And, of course, this goes back to our conversation about how farmers could potentially be targeted here. Of course, as As you'll recall, the U.S. ag industry lost about $26 billion between 2018 and 2019 during the first trade war with China. But then I'd also point our attention to some of these other targeted actions that Beijing is taking, including when it comes to targeting increasing export controls on critical minerals. That's going to be another pressure point for this White House, as well as the future of the TikTok deal. There's a lot of different facets to this conversation.
Hey, Tyler, great work as always. Tyler Kendall there. Out of the nation's capital, with us around the table, Chris Harvey of Wells Fargo still. Chris, this is where we really started the conversation. Where does the circuit breaker come from? Could it come from Capitol Hill?
It has to come from Capitol Hill. You have to hear the administration acknowledge what's going on, and you have to have them acknowledge and communicate that they see it, they understand it, and you have to have them start to slow things down. This conversation about a 30-day pause, a 60-day pause, a 90-day pause, something has to happen. You cannot continually walk in and have more tariffs and more stress in the system, because the more you do that, the faster we go to a recession, the faster job losses come, and the faster this gets out of control.
But right now it's just rhetoric. Do you actually see Congress pulling back the reins and trying to take control, giving less authority to the executive branch when it comes to trade policy?
Yeah, Annmarie, I think if it continues, you go down that route, but that's a much slower route, right? And the markets are going to move much quicker. And this is a question of confidence. Do the markets, do business folks have confidence in the plan, and what's the spill out from the plan? And right now, the markets are saying we're losing confidence, and we're losing confidence quickly.
So when it comes to circuit breaker, you think it's actually Republicans in Congress that could be the ones that put a stop to this? You don't see maybe it Xi Jinping or Donald Trump himself blinking?
I don't see in the conversation. So a couple things there, because that's a big question, right? The situation between China and U.S. appears to think that China is the existential threat. We can have that continue, and likely that does continue. But if we get positive news from the EU, from Japan, from other places where there is actually progress, then things can improve. China is toward the end of my concern at this point in time. Can we get our allies to come on board? Can we strike deals? Can we move forward? Can we make progress? If we're showing progress, the markets will react positively. If we do not show progress, the markets are not going to react positively.
There's a story in the Financial Times about how U.S. ports are getting really crowded, that a lot of companies are delaying their car shipments, and they're just holding them at the ports, hoping that maybe in a couple days these tariffs will be removed. Maybe it'll take 4 days, maybe it'll take 5 days, and they're about to reach capacity at these ports. What will it take for both companies and for the markets to realize this is real?
Listen, it's real, right? So the complexity of this, you cannot turn around in a couple days, in a couple weeks. Because you've basically tariffed or taxed almost every single country out there, in order to unwind that, it's no small feat. The other thing is governments do not move quickly, right? And because of what we've done, people want to protect themselves. So they're going to have to talk to their lawyers, to their leaders, to their parliaments or whoever before they take some action. We can have the conversation, but the actual action and execution is going to take, I think, a long period of time.
What are we seeing in markets? Is this just the fear that this is going to have a suppression to growth, or are we getting actually a sense of what markets are repricing as the new normal?
Yeah, the markets don't really know the end goal, right? Is it negotiation? Is it revenue generation? Or is it something much bigger, right? Do we want to change the way we do trade throughout the world and for the rest of time? That's a big question. So the markets are just trying to figure out what's going on, and the markets are trying to send a message. We need better communication. We need to understand the goal. When we get to the goal, what are you going to do, and how are we going to do it?
To start that process, to engineer that supply-side response, you've got to believe that these are the rules of the game. And we're still sat here saying, is this a negotiation, or are these the rules of the game?
I love how Chris puts it. The market is crying to the White House. We want better communication. Can we have a therapist come in here and try to clarify what the end goal is? Are we meant to be together? Are we meant to be apart?
Is this therapy again?
Well, it sounds like a lot of people are trying to get into the psychology of the moment.
What do people say? Cry harder. That's what we're doing right now.
I think that's what we're doing on every single market.
Got to find some light humour in a moment like this one. We're down again by 1.4% on the S&P. A special thanks to Chris Harvey of Wells Fargo. If you're just tuning in, welcome to the programme. Moments ago, about 25 minutes ago, we got China's response to the overnight tariffs from the US side. 84% on US goods. That's driving equities lower, not just stateside, but in Europe too. And in the bond market, bond yields are higher, not lower, again this morning. I know that got the attention of many of you yesterday. It's where we're focused again this morning. Why aren't we seeing that haven bid into treasuries? Yields higher by 8 basis points, the 10-year 437.42. Earlier on this morning, Delta Airlines coming out and pulling guidance. Up next, we'll catch up with Sheila Kahyaoglu of Jefferies from New York City. This is Bloomberg. Live from New York City, welcome back. Equity futures sliding here by 1.2% on the S&P 500. On the Nasdaq, lower as well by 0.9% on the Russell. We're down by 1.8%. 30 minutes ago, we learned China's response to America's tariffs. China raising the tariffs on US goods to 84%. With 2 hours until the cash open, let's get to your morning movers. We can do that this morning with Danny Berger. Hey, Danny.
Hey, John. Look, it's been a volatile morning for the benchmark, but one thing has been consistent, and that is the pain in pharmaceutical stocks this morning. Pfizer down nearly 4%. If it closes at the level it's currently at, it would be its weakest price since 2016. The sector under pressure after President Donald Trump last night saying that there would soon be an announcement on pharma tariffs. BMO writing that for the industry, they'll be unable to move their supply chains because they are so complicated. This shatters the illusion of safety that they would be spared. Some earnings to work through. Delta, we've been talking about this all morning. Here's one of the playbooks. You can just give no guidance. They withdrawing their guidance for the full year, citing the uncertainty, saying that they would provide more clarity once they get it. Also cutting their capex and their capacity, saying that we are controlling the one thing that is in our control, and that is margins. You can see Delta shares, though, barely holding on to the gains at this moment, up 1/3 to 0.4%. Here's another playbook for earnings, and it comes from Walmart. They have their full earnings on May 15th, but ahead of that saying that we are keeping our first quarter outlook unchanged. That's a gain of 3 to 4% in sales. Our fiscal year 2026, that's also staying the same. Of course, the irony, though, is even though they've kept their guidance the same, shares are falling 1.6%. But, John, unfortunately for them, they pre-announced that just at the same time as those China tariff headlines crossed.
Hey, Danny, appreciate it. They might have some work to do on that outlook, that's for sure. Danny, appreciate it. Equity futures on the S&P then sliding. On our radar this morning, President Trump's historic tariffs on China taking effect. The latest round of levies pushing as high as 104%. Trump also slapping 20% tariffs on the EU. China's responding with levies of 84% on US goods. The countermeasures going into effect tomorrow. China also adding 6 firms to its unreliable list and 12 entities to its export control list.
So this is now the full tit for tat. You see this escalation and this rift. What I would say is, what is the off-ramp? Who blinks first? Trump claimed yesterday China also wants to make a deal. He said they want to make a deal badly, but yet Xi Jinping has not called. Caroline Levitt then was asked about this, and she said, we will be gracious if China's leadership reaches out. Well, guess what? They're reaching out with an 84% tariff.
How do companies respond to this? Let's say these do stick. Do they just expect that they'll eventually be taken off? Do they make investments to try to shift the supply chain? And then to where? Is it back to the United States? I think Walmart's guidance was interesting because they did say that they have a wider range of outcomes for its first quarter operating income growth. And get this, for some sort of nice euphemism, they may have to, quote, invest in price, which will, quote, widen the range of outcomes for its first quarter operating income growth. In other words, they might have to eat it. And that might eat into their profit margins, and that might be what you see from them.
Thanks for attempting to translate the McKinsey, because I think we're going to see a lot of that in the coming weeks, aren't we?
I mean, how do you say something that is uncertain and that potentially is highly unsavory? Markets are able to also translate McKinsey, which is maybe why the shares are a bit lower.
This is going to be highly industry specific, and we've all said around this table repeatedly, you need to be very open-minded about the kind of consequences that we could see. Clearly, for the airline business, you cut capacity because you think things are going to be not as busy as you thought they might be for the year ahead. For other companies that might have to increase capacity to meet domestic demand, they're not going to do that until they're 100% sure that these are the rules of the game. And the administration has spent the past few days saying you can negotiate. So in the meantime, what are those companies, what are those industries going to do?
Especially if you're worried about pricing power and you're worried about a consumer that is exhausted and not able to take on that much more. Well, that means that they can't really expand their profit margins to offset any potential increase in the costs that they are seeing. So what do they want to do? They want to sit tight. They want to have less inventory. They want to necessarily have less overhang and potential exposure.
We've mentioned Delta a few times this morning. If you are just joining us, these were the numbers. So basically what they've done is withdrawn their full year guidance, citing uncertainty around global trade. The CEO, Ed Bastian, saying, quote, "It's very difficult to predict what policies may look like over the course of the year. That's for sure." The stock is up by 1.7% as Bastian adds that revenue has flatlined. Joining us now to discuss is Sheila Kahyaoglu of Jefferies. Sheila, welcome to the programme. If Mr. Bastian can't offer any guidance, can you?
I don't think we can either. We cut our estimates earlier last week across the entire airline landscape, assuming flat domestic pricing for the year. What we're getting from Delta is suspended guidance, clearly, and that's probably the best strategic move from here. But it assumes something worse than that for Q2 in terms of flat domestic pricing, and then a second half capacity is flat. So not great news out of the U.S.'s largest carrier in terms of what they're saying.
Sheila, you've talked about this repeatedly. The high income bracket here in the United States holding up business for many of these airlines, premium, long haul. Sheila, are you seeing building evidence that maybe we're seeing something we haven't seen over the last 5 years, that they're starting to take the hit here?
I think premium and Atlantic are international are actually still holding up. We just got off the phone with Dan Junke, Delta CFO. It seems like the bookings visibility there is decent. What you're seeing the contraction is in the main cabin, which is where we would see it. But also notably corporate. Corporate really saw a move down in February and March. Industries that were particularly hit were industrials, aerospace, of course, and some other sectors, while financials and tech held in there, it seems. So corporate is also taking a leg down. So corporates are clamping up a little bit, whether it's the tightness in just, cost cutting, or if it's the macro volatility that's causing that is to be determined. So that's where we're seeing the premium hit is really within the corporate customer trending down.
We are seeing some commentary from Ed Bastian, the CEO of Delta. This in the Wall Street Journal. He said he understands there's a role to play with tariffs and trade policy. It's just hard when you're trying to do them all at the same time. He also said, "I don't think we're in a recession. I think we're in danger of talking ourselves into a recession." When you talk to executives, particularly from airlines, is there a level of frustration that the consumer does seem strong, willing to accept even price increases, still looking for experiences, at the same time that there's a lot of gloom and doom on Wall Street and a potential regime shift that could just torpedo that?
It's interesting because Delta's telling us they saw it within the consumer trend down really quickly, whether it was in February and March in the first 5 to 7 days of April. I'm actually in Atlanta right now. I'm at a trade show, an aerospace aftermarket trade show. And the 10 executives we met with yesterday were so confident regarding tariffs. They don't think it'll have as much demand destruction as people assume. And that pricing will actually be positive because they could pass it through to the end user, which is, of course, the airline, which is, of course, the consumer in the U.S. So I think we're seeing that short cycle hit with Delta this morning, a massive change with what they previously guided. They had guided a capacity up 4, now it's flat. And pricing also taking a swing down 2.5 to down 6.5 in their forward outlook for Q2. So we're seeing that major revenue cut, not only from a capacity perspective, but from a price perspective. And the airline's doing its best to stay profitable, show that it's it's positioned well for this with its relatively low leverage, but they're only growing their net fleet less than 1%. So taking into account Boeing Airbus deliveries and their retirements, that's less than 1%. So they're clamping down on their costs as well.
This is a really fascinating dichotomy right now, Sheila, because on one hand, you have the airlines saying, ostensibly, they believe they have pricing power. They believe that they can raise prices and that you could shrink potentially just your flight schedule and keep prices where they are, go higher and offset any kind of change. You're hearing something so different from the likes of Walmart that want to invest in price, i.e. absorb some of the increase in prices. Is there some sort of structural change that gives airlines a strategic advantage to being able to have pricing power?
So the airlines are clearly saying pricing is stalling. Pricing and capacity are stalling. The aerospace show I'm at is more the manufacturers and the maintenance providers to the airlines. They're still seeing that they have the ability to pass price through. One is a shorter cycle buy. With an airline, a consumer booking is maybe 30 to 90 days, and that's where we're seeing the hit with Delta. The aerospace show I'm at is probably 30 to 1 year buy cycle. So the shorter cycle is definitely seeing the market volatility impact its demand and its pricing.
Sheila, Delta is a Virgin Atlantic partner on its North Atlantic routes. We saw Virgin Atlantic pull back some of those routes, especially when it comes to New York City, this major hub, JFK. Are you expecting more airlines to pull back some routes?
I think international is the region we're going to watch the most. So to put it in perspective, in terms of domestic is very important. Delta had previously $7.35 of EPS. Every 1 point of domestic pricing is about 85 cents to EPS. Internationally, every 1 point of pricing is maybe 20 cents. Internationally is still holding up, but what we're seeing there in the second half and into in Q2 and the second half is actually a decent amount of capacity, whether it's Delta, whether it's United, whether it's American. Capacity is up mid-single digits, up 4%. So if you have a lot of capacity, not a lot of demand, what happens? Your price gets cut. So Atlantic is still holding up strong in Q2. They're fairly well booked into April. I think 90% booked in April, 60% booked in May, and 40% in June. And that's system-wide. So internationally would be better than that. So right now, international is still holding up. But again, that's a longer sales cycle, probably 90 days instead of 30 days for the domestic side.
Sheila, appreciate your time. Thanks for jumping on. Busy morning for you, I'm sure. Sheila Kahyaoglu there of Jefferies. The latest on Delta as they pull their guidance. That stock is positive for now in the pre-market by around about 1%. The big headline this hour, though, escalation. It comes from China. China turning around and putting 84% tariffs on US goods in response to major tariffs from the United States overnight. Equity futures this morning, near session lows, down by 2% on the S&P, negative 1.8% on the Nasdaq. In the bond market, this move continues. Bond yields higher across the curve, up by 12 basis points on 10s. On 30s, up by 12 to 4.88. The headline that we're getting from the Treasury Secretary in the last few moments, speaking to the American media a little bit earlier this hour, saying this on the tariffs. This escalation is a loser for them. Turning around, the Treasury Secretary saying it's unfortunate. The first response from the administration following those tariffs this morning.
Where's the off-ramp? Are we seeing it in these comments? Not necessarily. From President Trump, is he really going to back down when he's talked about going in harder? This really is becoming a tit-for-tat of retaliation, and the ripple effects not only for some of the exports from China to the United States, but also U.S. companies that rely on Chinese sales. How significant will that be?
What Scott Bessent told to me, the Treasury Secretary, after Liberation Day was that this is a cap. Do not retaliate, and potentially we could bring your tariff rate lower. We heard that again from Jamieson Greer yesterday, speaking into the Senate. So I'm not surprised that Treasury Secretary Scott Bessent is coming out today and saying this is unfortunate, because what they wanted to see was cool heads to prevail, so they would have these windows of opportunities to strike deals.
We said to the Commerce Secretary only a few weeks ago, just last week, came on the programme and we turned around to him and asked, are you underestimating or misestimating the amount of leverage that you have over China? Because they're not coming to the table. They're not coming to the table. In fact, they're retaliating. Now, I think overnight we saw some comments and people thought that maybe they were ready for talks. But based on that headline, that's not what this president's been asking for at all.
No, they're retaliating, and they're not just retaliating with tariffs. They're also putting more American companies on the entity list. They're going after export controls. You know what else they're doing? They are having outreach with European leaders. Ursula von der Leyen yesterday, the Spanish Prime Minister today. Xi Jinping will be making a trip to Cambodia and Vietnam later this week. They are trying to shore up regional allies and the Europeans to say, look, if the walls go up and you can no longer do deals with the United States, we will be your safe haven. We will be a place that you can still do business with and trade.
Speaking of safe havens, can we pull up the bond board again? 2-year, 10-year, 30-year. Bonds are not acting as a haven right now. Lisa has talked about this repeatedly so far this morning. Speaking of the Treasury Secretary, later on this afternoon, he is going to be very focused, Lisa, on what you're focused on every single week. The supply coming from the Treasury, $39 billion of 10-year notes.
This has the potential to be quite messy. A lot of people have been talking about that. A lot of banks are trying to pull back on risk. So if they are forced to bid on these auctions, they are going to be shorting treasuries elsewhere to offset that potential exposure. There isn't the absorption capacity that a lot of people were expecting. So yes, it could be basis trades unwinding. Yes, it could be foreign selling. Yes, it could be just simply a lack of buying. But you add $39 billion of supply to this, it becomes a real potential note of concern.
We add another 12 basis points to a 10-year Treasury yield. We're through 440 this morning at 441 on 30s, getting closer and closer to 490 at 488. A lot to get through. A lot to get through this morning. Let's get to it. With your Bloomberg Brief, here's Danny Berger. Hey, Danny.
Hey, John. Ankara is withdrawing its director nominations for U.S. Steel's 2025 annual meeting. The firm citing reports that Nippon could be gaining support from the Trump administration for its takeover bid of U.S. Steel for $55 per share. Monday, Ankara unveiled a plan to jumpstart U.S. Steel and nearly double the stock price to $75 per share. A former Meta executive plans to testify before Congress that the company briefed the Chinese Communist Party on emerging technologies, including AI. The corporate whistleblower alleges that Meta aimed to help China outcompete American companies. Meta, for its part, denies the claims. Elsewhere, demand for used gold Rolex watches is on the rise. Gold prices have, in turn, risen more than 10% this year. The Bloomberg Subdial Watch Index, which tracks prices for the 50 most traded models, has 3 gold Rolex timepieces climbing the most places up since the index was launched in 2022. And that's your brief, John.
Hey, Danny, thank you. More from Danny later on in the hour. Up next on the program, betting on the Fed put.
If it's foreign selling, we could go towards 450. I do believe the Fed would step in because the plumbing of the system is no longer working at that level, and they will step in to stabilize the plumbing and have proper market functioning.
Up next on the program, we'll catch up with Tony Rodriguez of Nuveen from New York City this morning. Good morning to you all. You're watching Bloomberg TV. Waking up with a cup of escalation this morning from China, raising tariffs on U.S. goods to 84%. The bond market offering no comfort at all. Yields are higher across the curve, up by 8 at the front end. On a 10-year, up by almost 13. On 30s, up by 11. 488. Under surveillance this morning, betting on the Fed put.
Heading into Liberation Day, we thought that last week would be the week of peak uncertainty. It was not. I'm not a believer that the price or yield that you see is a reflection of market expectations. It's a reflection of that marginal buyer or seller. If it's foreign selling, we could go towards 450 if it is. I do believe the Fed would step in because the plumbing of the system is no longer working at that level, and they will step in to stabilize the plumbing and have proper market functioning. It is one of their roles. So for that reason, we believe in US 10s at 420 to 450 is a buying level.
Here's the latest this morning. The Fed isn't racing to step in, and the bond market is offering very little comfort. Tony Rodriguez of Nuveen writing, we forecast the 10-year yield at 4% for year-end, though we expect volatility to remain elevated and for the trading band to remain wide in the near term. Tony joins us now for more. Tony, good morning.
Good morning. Good to be with you.
Let's get straight to that bond board. It's good to see you. Yields are up across the curve. Why are they up across the curve by double-digit basis points on 10s, on 30s?
Well, there's a lot of reasons that people are providing. In our view, there's a couple of main ones. Inflation, number one. Inflation is going to be significantly higher than we had expected prior to these latest rounds of tariff increases. And obviously, that's very negative. Number two, the inflation hit is up front. The growth drag is a little more delayed. So we don't expect to see any kind of rally in rates until we start actually seeing the hard data begin to reflect the slowdown. You also have, in our minds, foreigners that are backing away from the market, less confidence in the dollar, less confidence in U.S. policy, so you get that. And the third thing is the leverage unwind. With these kinds of moves and this kind of volatility, everyone is lowering their leverage. a lot of basis trades people talk about, et cetera. You're seeing that. So I think there's a bunch of factors, but they're all pointing in the same direction. And there's no offset, like you would say, well, maybe the Fed will step in. There's nothing for the Fed to step in for yet.
We'll get to the Fed in a second. Earlier this year, there was the Bessent put. Everybody said don't bet against the Treasury Secretary, who was saying that he was targeting 10-year yields and wanted to see them lower. Is the Bessent put dead?
Yeah, I don't know if the Bessent put ever really existed because I don't know what policies they had set up in order to drive those yields lower. This Bessent put is related to an economic collapse from tariffs that are, 50%, 100%, et cetera. So you might get what you want, but you get it for the wrong reason. So we don't think the Bessent put is there. Right now, the tariff policy is really the main driver because that's what's impacting inflation and that's what's impacting the medium-term growth hit, which is why you're seeing all the selling in equity markets, for example.
Not to get too existential, but what is your confidence level that in the case of a real growth slowdown or even a contraction, the Treasuries would be the haven bet, that you would get a massive bid in, that yields would go substantially lower? Because if the U.S. wanted to give some fiscal support to this economy to get it out of some sort of recession, its hands are a bit more tied than it has been in the past.
Absolutely. So the ability to respond to that slowdown is very challenging, which is why we think growth, while we're not yet forecasting recession, we're forecasting 0.5% growth if we stay with tariffs that are around this level or even move back to tariffs that are, let's call it, around half of current levels. If we stay at these levels for the balance of the year, then we tip into a recession call as well. And in that environment, because it's driven by U.S. policy, kind of that self-inflicted wound, then it is possible that Treasuries won't provide that haven. You won't see as much of a rally. You'll still see, we think, yields decline, but they won't decline to levels that would be typical in a more market-driven, economic shock rather than a policy-driven, self-inflicted wound.
Tony, let's just recap these headlines from Secretary Bessent again. He's speaking a little bit earlier this morning, and this is what he said. What he sees in the bond market, normal deleveraging in the bond market, nothing systemic. There's a word that was thrown around going into the weekend. I threw it around too, orderly. What's the difference between orderly and disorderly, and how close are we to the latter and not the former, given the moves we've seen in the past few days?
Yeah, I'd say we're still on the orderly side, and the main difference in our minds between the two is when you have a financial accident. You have a leveraged fund that basically goes under. You have, for example, if you look at cross-currency swap spreads, they blow out. You look at short-term funding markets, they implode and, for example, seize up. We're not seeing that yet. We're seeing all of the initial steps in that direction. So certainly the markets are challenged. They're not quite crossing over the line into disorderly yet. But with every day that we see continued volatility, continued escalation in tariffs, I think we get a lot closer to going across that line. That's when the Fed might begin to be able to step in.
Not to put words in anyone's mouth then, isn't the Treasury Secretary basically telling the Federal Reserve there's nothing to see here?
Yes.
There's nothing disorderly to step in and fix. That's the message from the Treasury Secretary this morning based on these comments. Nothing systemic, normal deleveraging in the bond market. So if he's saying there's not a problem, why would the Fed step in? For market functioning reasons.
And what exactly could they do? If they cut rates on the short end, would that actually help or hurt the long end? Deutsche Bank's George Saravellos came out this morning and said if recent disruption in the U.S. Treasury market continues, we see no other option but for the Fed to step in with emergency purchases of U.S. Treasuries. Talk about kind of what the Bank of England did back with Liz Truss back in 2022.
Certainly got echoes of that. Tony, just a final thought. What do you do from here? What's your approach to this market?
Yeah, so tremendous uncertainty, so you need to be more conservatively positioned than you were. You need to have more cash, right? So liquidity is paramount in this kind of environment to be able to take advantage eventually of a dislocation. And you need to be following the metrics that will indicate whether there's any kind of backing off. We don't see that right now from any foreigner, like China's not going to step up to the table in our minds. They're watching what's occurring, and really, that's applying very little pressure. The more they wait, maybe the uglier things get, and all of a sudden the leverage shifts a bit. So we think we're going to be in this period for quite some time.
Tony, it's good to see you. Thanks for breaking things down for us. Tony Rodriguez there of Nuveen. Breaking down this bond market. This bond market's breaking down. Yields are higher by 14 basis points. The 10-year 4.43. Twos are up by 7. At the front end of the curve, 3 80. And the equity market's rolling over as well. Equity futures on the S&P negative by 1.9%. The third hour of Bloomberg Surveillance is just around the corner. Your lineup looks like this. We'll catch up with Richard Bernstein of Richard Bernstein Advisors. We'll speak to Ryan Petersen of Flexport, Sarah Wolfe of Morgan Stanley, and Ruchir Sharma of Rockefeller International from New York City. This is Bloomberg.
Most market participants are not expecting tariffs to last longer than a couple of months.
There are some longer-term positives if we can potentially negotiate some with these tariffs.
The one clear conclusion from tariffs is that they are U.S. growth negative.
All these things really aren't sustainable in the long term.
If the full expected tariffs come through, that would likely trigger a recession.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning, 90 minutes away from the opening bell, and we've got some escalation to talk about. Major tariffs go on overnight on the rest of the world from the United States of America. Equity futures gapping lower going into that opening bell as China responds. China retaliates. Here's your escalation. 84% tariffs on U.S. goods. Equities down across the board. On the Nasdaq, we're lower by 1.6. On the Russell, we're down by 2.6. In the bond market, no comfort provided whatsoever. Yields are higher across the curve, up by 8 basis points on 2s, up by 16 on 10s, 445 on 30s, approaching 5%, 491 this morning. And later on this afternoon, we've got some bond supply for you, 1 p.m. Eastern time. This is the number for the 10-year auction, almost $40 billion of 10-year debt coming to market. The Treasury Secretary, Scott Bessent, speaking this morning, saying it's normal deleveraging in the bond market, nothing systemic.
Well, there is something systemically that is a bit awry or making people deeply uncomfortable. It's that bond markets are not providing a haven right now. They have not been the market of choice, even as you see German 10-year yields go lower, as well as French 10-year yields, and you pick your domestic market of choice. You're also seeing gold that now is rebounding, but the dollar also weakening. So all of these haven trades are no longer functioning at a time when so many people are wondering, what is the new world order going to look like?
Well, this is what the president would like it to look like. He spoke a little bit early this morning, posted on social media. This is a great time to move your company into the United States. Don't wait. Do it now.
But companies are waiting on the sidelines. It's paralysis. They want certainty. And what have we heard from every single guest today? We're at almost peak uncertainty. We don't know what the next steps are. We are still sitting around the table today and questioning, is this a negotiation? And the Treasury Secretary earlier this morning saying that actually it's exciting because you have places like Vietnam coming today for negotiations. They're excited to start negotiations with Japan. At the same time, we are in a serious escalation when it comes to Beijing.
To engineer that supply side of response that you're talking about, to engineer that supply side response, you need to believe these are the new rules of the game. And as long as you go around talking about negotiating, companies will just sit there and do nothing. They're not going to build that factory until they know for sure those tariffs aren't going away.
There is a maturity mismatch, as that one viewer yesterday wrote into you, in terms of the near-term impact of tariffs versus the long-term response of possibly building out factories. Look, right now, as the president tries to negotiate, it seems like the market is giving it less leverage to move, given the fact that the market is saying that companies are going to suffer. You're seeing Walmart coming out and saying they're going to invest in price, i.e. have smaller margins as they try to maneuver through this. And you have Delta saying that they are going to cut capital expenditures as they batten down the hatches to deal with this uncertainty.
It's another morning facing the same question. We've said this on this program repeatedly. Are these the rules of the game, or can you negotiate? And a pendulum keeps swinging between the two. Every single day, hopes for a deal, fears about tariffs, a headline about equities up or down. Annmarie, the underlying trend, and you've been talking about this for weeks now, if not months, the underlying trend is that tariffs are going up. They're higher than they were a week ago, 2 weeks ago, and they keep climbing higher.
And even if there are deals, most people think that no one's going to get a deal below 10%, that baseline they set for every single country on that list, on that board the president came out. So regardless, there will be higher tariffs. But can you have potentially a deal where there's something towards reciprocity? I still think there's potential for that for most countries besides one, and of course that's China.
So seen, equity futures down by 1.8% on the S&P, bond yields higher by 16 basis points. The 10-year, 445. Coming up this hour, we'll catch up with Richard Bernstein of Richard Bernstein Advisors as trade tensions shake up markets worldwide. Ryan Petersen of Flexport as shippers brace for the impact of Trump's tariffs. And we'll speak to Ruchir Sharma of Rockefeller International on why the Fed shouldn't try to save the world. We begin this hour with stocks lower. After 4 days of losses on the S&P 500, Richard Bernstein of Bernstein Advisors writing, the Fed is caught between a rock and a hard place. GDP forecasts are being revised downward, but inflation expectations seem poised to accelerate. Richard joins us now for more. Richard, welcome to the programme. You put it in your note. Everyone's got a plan until they get punched in the face. That famous strategist on Wall Street, Mike Tyson. How strong is that punch this morning?
I think the punch is a real. It's not a jab. It's a real roundhouse punch, and I think. John, look, you've been talking a lot about all the different uncertainties and all the different things that are going on. That's fine, but I think one also has to realize that we entered the year with investors historically confident. So this has a magnified effect on investors' confidence that they're being shaken. So that was my point about that everybody has a plan until they get punched in the mouth. Because everybody had a plan. They thought it was easy. They thought this was like, oh, let's just buy an index fund or let's buy the Mag 7. And all of a sudden they're realizing that was the unusual period. And now we're going back to something that's much more uncertain. And they're getting punched in the mouth.
Richard, Scott Bessent, Treasury Secretary, speaking with Annmarie, our own here, and saying that this then is not necessarily a MAGA problem, it's a Mag 7 problem. Do you agree? Is that basically what you're seeing right now is the unwind of an overvaluation of a crowded trade at the end of the last year, beginning of this one?
Well, Lisa, I understand where he's going with that question, but my response would be, why is the Russell 2000 underperforming so dramatically here? If it were just a Mag 7 point, why are the most domestically focused companies in America, smaller companies, are underperforming, right? So how is this just a large cap MAGA effect? It's clearly not, or Mag 7 effect, sorry. It's clearly not. I think this is a comment. The markets are making a comment on the broad economy in the United States, and I think also the notion that this is an orderly process. That's fine. I would agree with that, but the process is not a positive one. The markets are not giving a positive verdict on that, and that's kind of what I think people are still sort of missing here.
Richard, how do you navigate a situation like this where the rules of the road may be called into question over a longer period of time and asset allocation potentially could look very different if the trends that we're seeing in markets today would hold? So how are you thinking about not just short-term investing, but the 1 year, 2 year, 5 years ahead?
Right. So Lisa, I think in the short term, you're using the word uncertainty. Everybody's using the word uncertainty. I shouldn't personalize it like that. Everybody's using the word uncertainty. So what that means is the scarcity in the marketplace is certainty. That's what will command a premium through time is certainty. What does that mean? That means quality. That means more certain cash flows. It means dividends. It means really kind of focusing on near-term fundamentals as opposed to long-term growth stories. The second thing is, what do you do for 3 years, 5 years, 10 years, 2 years, whatever? And I think, look, the goal of what's going on, of returning industrial processing back to the United States and manufacturing back to the United States, I think that's a great goal. In fact, we've been talking about it at my firm at Richard Bernstein Advisors for 10 years. I wrote an op-ed in 2011 in the Financial Times about this topic and how important it was. The goal is real. However, the method that they're choosing to try and get to that goal, personal opinion here for a second, is incredibly ham-handed. There are many better ways to do it that do not place a tax on the U.S. consumer.
Richard, we heard from one ECB official earlier on this morning that said there's no reason for a rate cut right now. I think he referred to 50 basis point cuts as ridiculous. Mary Daly, the San Francisco Fed president, putting out a post on LinkedIn saying we have the time and space to deliberate our next moves. Lisa, that's what's different about this moment. These officials at these central banks aren't rushing to race in, rushing to step in and provide support like maybe they would have done a number of years ago.
And for the correct reasons, which is this is a very different type of crisis that is not of the credit markets making. This is about policy uncertainty and the potential stagflationary shock that comes along with inflation. If you take a look at 2-year break-even rates, they've actually hit the highest level going back to 2002 earlier this morning. It's shifting around incredibly volatile markets, but the signal is not so clear in terms of how they should act, let alone if.
Richard, are you thinking about where pockets of leverage might be? This has been a really unusual cycle here in the United States and worldwide because of the support that was offered through the pandemic and through the recovery as well. When you think about where pockets of leverage might be this time around, how do you answer that question?
So John, it's related to what you and Lisa were just talking about. The Fed was spoiled for many, many years, three decades, by globalization. Globalization was a massive disinflationary force on the U.S. economy. Why? Because we were just increasing competition. And we all know when you increase competition, you put downward pressure on prices. So the Fed could play the hero and ride in on the white horse and save the day. Now what we're seeing is deglobalization. That whole disinflationary process is now being reversed, so it's now an inflationary process. That ties the Fed's hands. And the Fed can't play the hero anymore. And I think that's one of the things that's happening. So where is the pocket of leverage? I don't really know. You know, one could argue that it's in the private market somewhere, because I think that a lot of their returns have been boosted by leverage and the ability to borrow cheaply to make acquisitions. There's where it is. It's certainly, not going to be, I would argue it's unlikely to be in the big banks. The big banks, for all their whining about over-regulation, big bank balance sheets are pretty strong. It looks like the regulation has worked. But where is that leverage? It's in things like private debt and all of that. So the risk hasn't gone away. It's just moved, I think, from the public markets to the private markets. It's an interesting a monetary and fiscal question is that if there is some kind of problem in the private markets, they're supposed to be private, will they come to the rescue? I would think they'd be very hesitant to do that.
The Treasury Secretary this morning is saying really nothing to see here. I feel like I'm going to sound like Lisa, but how do you think this bond auction is going to go today for the 10-year?
Well, a little outside my area of expertise. I just don't think, I think what we are seeing is a complete repricing of U.S. assets with a higher risk premium, right? If you think about it, we've taken about 5, maybe 6 multiple points off the S&P despite good earnings. We're seeing in a very short period of time the 10-year sell off, but certainly bond volatility has gone up, whether you agree with my statement about the risk premium or not. Certainly bond volatility has gone up. And I think what's happening is U.S. assets are being repriced. You mentioned before about, are we a safe haven anymore? Maybe not. And that's kind of what we're seeing.
I spy the Tottenham emblem right behind you as well, Richard. Super depressing stuff for you, eh? Appreciate the time, as always.
Rough season.
Thank you, sir. Richard Bernstein of Richard Bernstein Advisors. Thank you very much. Equities near session lows on the S&P 500. Difficult moment for this equity market. Just to breathe some life into that conversation on the central bank pert. Who remembers that news conference in 2020? Christine Lagarde at the ECB. We are not here to close spreads. What does she do later on? Close spreads. Everyone's got a threshold. The difference this time around is that because of the nature of the shock and the potential economic consequences, that threshold might be a whole lot lower than we thought it was for this ECB and likewise for this Federal Reserve.
The other wrinkle in this is that they have to be responding to immediate circumstances. During the pandemic, the entire world just shut down and travel shut down. And suddenly there was this question about supply-demand dynamics that were totally skewed. Right now, companies are not raising the sort of huge 5-alarm siren that you would expect. That is not what we're hearing from Delta. That is not what we're hearing from Walmart. How does the central bank respond to that with data that's still holding in?
I remember when people thought the president would back away at 5,500 on the S&P. And here we are sat the 5K at a close as of yesterday.
He didn't want to answer the question if there was a Trump put, if a threshold still existed. He actually said it was a stupid question, but then went on to say, sometimes you have to give medicine to fix something. This is self-imposed. This is policy medicine from what the president thinks should be fixed when it comes to global realignment. What's the cure to Trump's medicine is the question we're all asking this morning.
Super difficult question to answer. Equity futures at the moment on the S&P negative by 1.8%. With an update on stories elsewhere, with your Bloomberg brief, here's Danny Berger. Hey, Danny.
Hey, John, just to round up what we have in tariffs at this moment, President Trump's so-called reciprocal tariffs are in effect. That includes a 20% levy against the EU and a historic 104% tariff on China. That follows a 10% baseline tariff for most U.S. trading partners that took effect on Sunday. Now, in retaliation to those moves, China is raising tariffs on imported U.S. goods to 84%. A government statement released over an hour ago said that the countermeasures will come into effect on April 10th. China also said it would sue the U.S. at the WTO and added 6 firms to its unreliable entity list. Elsewhere, Delta Airlines has withdrawn its full-year financial guidance, citing uncertainty surrounding global trade. Shares up about 1/3%. The company said that it will update the outlook later in the year as visibility improves. It also trimmed CapEx and cut its plan for capacity growth to flat for the second half of the year. And that's your brief, John.
Hey, Danny, thank you. Appreciate it. Another update from Danny coming up in about 15 minutes' time. Up next on the programme, we'll get you some morning calls. Plus, we'll catch up with Ryan Petersen of Flexport as shippers brace for the impact of Trump's tariffs and China's retaliation. From New York, this is Bloomberg. Live from New York City, your equity market looks like this. 1 hour and 13 minutes away from the opening bell. Equity futures down across the board. A wild few sessions to start the trading week, that's for sure. We're down by 1.8% on the S&P. On the Nasdaq, we're down by 1.5%. Retaliation from China, 84% tariffs on U.S. goods. After the U.S. slapped major tariffs on the rest of the world overnight, equities are down across the board. That's the price action. Let's get to your morning calls. First up, Jefferies upgrading Apple to hold, expecting a potential tariff exemption for the company, but noting downside risk. That stock is down by 2%. Everyone still thinks, who covers that company, that we'll get that exemption. Let's see if we will. Next up, Benchmark adding Tesla to his best ideas list, saying concerns over declining sales are overblown. The stock is down by 0.7%. And your third and final call comes from Bernstein, downgrading Ford to underperform, seeing significant downside for the stock due to tariffs. That stock is down by another 2.4%. Let's stick with those tariffs. Global shipping taking a major hit. Ryan Petersen of Flexport saying 28% of the customers in a company call last week said they're pausing all ocean freight bookings from Asia until there's more clarity on where tariffs will end up. For a clinic on shipping and a whole lot more, Ryan joins us now for more. Ryan, welcome to the programme, sir. I want to start with a really important question because I think there's tons of confusion out there about this. Help me understand. If a ship is already at sea and has declined, say, a port, has left a port in, say, Asia, and they arrive in a week's time, do they pay the tariff or not?
No, they would not pay these new reciprocal tariffs. The way that it works, I mean, typically throughout history, it's based on when the goods arrive. That's what the duty rate that you pay is. However, with these reciprocal tariffs, they made it so that as long as your ship departed by midnight last night, then you only pay 10%, a 10% additional tariff. It was midnight, April 5th was the deadline to pay no additional tariff. So if the goods have been out there on the water since then there's no tariff. So there was a mad scramble the last few days to get every container into the ports and loaded, and hopefully those ships departed. Hopefully your ship departed by midnight last night.
Yeah, Ryan, could you help us describe that?
That is midnight Eastern time, not local time in Asia.
Interesting. Can you just describe then how that mad rush came about and what that looked like over the last few days?
Yeah, I mean, a lot of containers actually switched to air freight to make sure that they got out on time. There was just this rush. Ocean freight, the goods have to arrive at the port several days before the ship departs. Air freight, you can tend to get to the airport in a matter of hours before the plane leaves. So there was a switch over to air. I read somewhere that Apple chartered 5 747s for iPhones. So yeah, like a big scramble to get things. Flexport team, we're one of the largest logistics companies and customs brokers in the world, and we had a team working all weekend, paying overtime and taking care of people to get to put in extra effort this week for our customers.
So China's getting hit with 104%. Beijing comes back with more than 80% this morning on American imports. You're talking about this mad rush to get product out of China and out of Asian ports. Well, then what happens in a few weeks? Is it a mad halt?
Yeah, I mean, you saw that in the survey result that you posted there from Flexport's customers. We are seeing expecting quite a slowdown based on what customers are telling us. And it's not necessarily that there's three possible reasons for this, in my view. Number one is that people knew this date was coming for a long time, and they're well stocked. They imported a lot of inventory ahead of time at the lower duty rates. So that part, they're going to sell through those stocks. Two, as I mentioned in the tweet, there's a lot of uncertainty. I think people believe that tariffs may come down. The White House, the administration has been signaling in all kinds of different ways that they're making deals. Japan, Korea, like a whole bunch of countries have come in and said they would drop U.S. tariffs in exchange for a deal. So if you think duty rates are going to drop from these high levels, then that would make sense. And then the third possibility, and the one that's the most worrisome, is the business model isn't working as well. I mean, people are going to have to raise prices because these tariffs are so high. There's no other choice. And, the one thing we know from economics is if you raise prices, you sell less stuff.
So, Ryan, when do you think that could actually happen? Prices going up?
We've already seen that start to happen. So it's looking like you look at our customers and you check all their e-commerce websites, we're seeing about a 5% increase in price that's already taken place. So even though the tariffs haven't started to get paid, they know it's coming, starting to factor that in. I assume prices will go up even further from there as they, the tariffs actually start getting paid, washed through the system, fed into more of the analytics of these companies.
Ryan, there are a couple of different pieces to this. On one hand, it's the tit for tat headline tariff rate. There also is this matter of fees on Chinese-built vessels, which potentially could also add to some of the costs. We're just getting news now from the Wall Street Journal that right now there is a revision to that where the new plan is to base the fees largely on vessel capacity, which could make it a lower fee. But from a broader standpoint, given China's dominance in the vessel creation, building of some of the shipping fleet, how significant would that aspect of some of these new levies be?
Yeah, so that's expected on April 17th is what we're expecting when a new ruling will come out about these fees that have been proposed on Chinese ships. It is potentially catastrophic. I can kind of overuse that word these days with how brutal the tariffs have been on customers. But the danger here is that they are, and we'll see how the new ruling comes out. I haven't read that Wall Street Journal article yet, but the way that they've been proposed is that it would be a per port call fee. And that would mean that it would create this real incentive for the carriers to skip the smaller ports because then they would pay less fees if they just make one port call at a major port instead of going to the small ports. Today, the ships will tend to, on the West Coast, they'll stop in Seattle, Oakland, LA. They'll make 3 port calls. So if you skip a few of those, obviously really bad for the jobs, both the port workers and the warehouses and everything around there. Very bad for importers and exporters, importantly, that are now having to truck their stuff all the way to LA instead of using the local nearest port to them. And then what you'll see is congestion at the major ports. And we saw that in COVID. LA just can't keep up with that kind of surge in volume. LA, Long Beach will get congested. New York, Houston, those are kind of the major ports on each coast. So you will see a lot of congestion in those ports. So yeah, hopefully they rework that. Looking forward to that. I've been pretty active, pretty vocal on the internet that this is kind of a crazy rule that's going to really hurt America's exporters and be self-defeating.
Ryan, just a final question. Busy week for you. Incredibly busy. How quiet might the rest of the year be?
I hope, we thrive off of this, man. I mean, I don't normally you don't invite your customs broker on television. So we're enjoying the fact that we get to be more valuable for our customers, show up, work hard. Like that's why we work in this industry. It's always pretty exciting, but rough for our customers. We're trying to do everything we can to help them work through this because a lot of their business models have been turned upside down overnight. And, yeah, I mean, there are some things that we can do for them, but a lot of it is trying to be as informed as we can be on top of what's happening and then working on strategies and solutions for them in real time.
Existential for some of them, I'm sure. Ryan, appreciate it. Thanks for making time for us. Ryan Petersen there at Flexport on the situation at the moment. I'm not sure how many people are aware that was actually how this worked. that it might be a number of weeks before you see that first ship arrive from China that has to pay the tariffs that went on overnight.
Right, because if already you are sitting on the sea, you have a little bit of a window room and you have some space. What I would also say is de minimis. These packages under $800, Shane, Temu, you see these teenagers buying off Instagram. Not only did the Trump administration close that exemption, if you're buying those packages, that tariff went up to 90%.
Those margins are like that. For so many of these companies, what we've seen overnight is truly existential. In the bond market right now, yields are up by 17 basis points on a 10-year. The 10-year at the moment, 4.47. From New York City, this is Bloomberg. Getting some corporate reaction this morning. Delta Airlines pulling their guidance for the year ahead. Jamie Dimon at JP Morgan speaking ahead of the earnings release on Friday, speaking to the press here in the United States a little bit earlier this morning and saying this: a recession is the likely outcome, echoing the views from his economist Mike Ferroli. That announcement coming out over the weekend. That's the base case for that team now. I expect more credit problems. Not seeing defaults yet, but I expect them. That's on the credit cycle. That comes from Jamie Dimon just moments ago, saying this about hedge funds. Lots of deleveraging from other players out there too, not just hedge funds. So that speaks to the bond market moves that we're seeing as well, Lisa, that a lot of people are curious about. If you are just joining us, equity futures on the S&P 500 down across the board here. The opening about 60 minutes away. Bond yields are higher by 15 basis points at the moment. The 10-year 4.45. The 30-year north of 4.90. Up by 13 basis points on a session so far. Let's get you some morning movers into that opening bell. Let's cross over to Danny Berger for more. Hey, Danny.
Hey, John. It's also been a really tough morning for the pharmaceutical stocks, with last night, Trump saying that announcement would soon come on tariffs on the pharmaceutical sector. BMO writing that this shatters the illusion of safety that many had believed because sectors weren't included in that initial tariff announcement from the White House on Liberation Day. Maybe they would be spared. It seems not so. Pfizer shares dropping 4.4% to the pre-market. If they hold at this level and close at this level, it would be their lowest price since 2016. Now, you mentioned the earnings. Let's just quickly go through those because we got one playbook from Delta. Those shares up about 0.33%, scrapping their full year guidance, saying that there's too much uncertainty to do so. And we will update you once we do have that certainty. Also going further to say we're controlling the things that are in our control, and that is margin and cash flow. So they're cutting their CapEx. They're reducing their capacity for the year. Ed Bastian, the CEO, may be on the bright side, saying this isn't COVID, this isn't bleak, this is just uncertainty. We also heard from Walmart, too. They, on the other hand, are keeping their guidance, both for this current quarter and the fiscal year of 2026. Now, the one area you do see tariffs come into it, they've widened that potential outcomes or operating income for this quarter to account for tariffs, but those shares down about 0.9%. John, they will report their earnings on May 15th.
Hey, Danny, thank you. The latest on Walmart there. The stock is down by about 1%. Easy to forget, but in the next 24 hours, you'll get CPI. You get CPI and PPI as well. Get some Fed speak too. Mike McKee can break it down for you. Mike, based on the Fed communication so far, they're not racing in.
No, they're not racing in. The Fed is keeping an eye on what's going on in the markets, but they want to make sure that the trades go through, that there isn't a disruption to market functioning. The fact that we're seeing volatility isn't going to make them happy, but it's not going to make them too concerned at this point. I've been talking to a lot of people in the markets this morning who basically say as U.S. markets open, it doesn't look as bad from a systemic point of view as it might when you're just looking at the price action. Futures trading for treasuries has been relatively calm, and we're not seeing big dislocations from a lot of people. So we have to keep an eye on what the Fed is doing today, but it doesn't look like there is an immediate need to step in. Now, Ian Lingen from BMO pointing out in his note this morning that we have a 10-year auction this afternoon after yesterday's bad 3-year. If we get a bad 10-year, especially signs that foreigners are not buying, then that could set off a significant market reaction. So things to keep an eye on.
Mike McKee, appreciate the update, sir. The breakdown of what to look for, not just the data and the Fed speak, but also that auction coming up a little bit later. I said it last week, that one morning you'd come in with equities down and down hard and bond yields were up. That was going to be the morning that would concern me. And I think it is concerning to see these moves in 10-year Treasury yields. Up 16 basis points.
It's concerning a lot of people, and there's a question of what happens to this bond market if there is a failed auction or some sort of catastrophic outcome, and that's clearly gotten people concerned.
The Treasury Secretary Scott Bessent speaking at the moment at the American Bankers Association Summit down in Washington, D.C. When we get some headlines from that, we'll share them with you. But this is the man to watch right now. He's pushing the idea that you can negotiate some of this, but at the moment we're just seeing escalation, particularly between the United States and China. Sarah Wolfe of Morgan Stanley writes, we revise our outlook for the US economy in the direction of even slower growth and a sharp firming of inflation. Sarah joins us now for more. Sarah, good morning.
Good morning.
Does that constrain the Federal Reserve?
Puts the Fed in a very tricky position. They're going to be on this wait and see hold. We're getting the FOMC minutes later today. Likely going to be a non-event. Chair Powell made it pretty clear on Friday that he's highly attentive to the outlook, but they're not going to move until they get some deterioration in the hard data. The soft data is not enough. So what gets the Fed to move by more? Markets are now pricing in over 4 cuts for this year. It's financial conditions. We're talking about the deleveraging that we saw yesterday. Credit spreads are widening a bit. There's a little bit of concern about what's happening in the private credit market as well. And so I think the Fed's going to be very highly attuned to how the financial plumbing plays out, and that could be what gets the Fed to move.
We've mentioned it a few times, that period back in 2018, in December 2018, when high yield credit really started to break down, spreads started to widen aggressively, and issuance completely froze. The Fed did step in. Are you seeing parallels to this moment, or are they constrained by the inflation story in a way now that they weren't back then?
They're definitely more constrained today, right? I mean, we were dealing with 1.5% inflation in 2018, so it was much easier for the Fed to be delivering cuts. They already were ready to be a bit more on an easing bias. Right now, the Fed is treading a very fine line where they're worried that long-run inflation expectations are going to be drifting higher with growth slowing down. It's a very tricky position for the Fed. But at the same time, if you have some type of liquidity issue, that's what could really start to cause the economy to tumble very fast. And so you see that the Fed will be very focused on the hard data when they can be, but then be very focused on financial conditions when they need to be. So we could start to see a little bit of a shift in Fed communication if financial conditions continue to deteriorate.
How much is an offset potentially of lower oil prices, given the fact that people are so worried about pricing pressure, and that this is a huge tailwind potentially if oil prices are going the lowest since 2021?
Yeah, I mean, oil prices are a tax on households if they go up, and they provide quite a bit of relief on the way down. And when we think about who's getting hit the hardest by tariffs, it's lower middle income households, and that's where gas prices matter the most. And so we do see that lower gas prices are going to free up some discretionary spending for these low income households. But at the same time, the fear is still there, and the price increases that we're going to see from tariffs across broad goods and maybe even trickling into the services sector in the medium run is really going to win the day over gas prices. So we might be getting a little bit of alleviation right now, but we've done some work on price sensitivity, income sensitivity, and households are going to be pulling back on durable goods.
Even the high-end consumer?
Even high-end. We're seeing it already with consumer financial expectations for high-end consumers has fallen more than lower and middle-income households. Think about the wealth effect. We've seen a $10 trillion loss in wealth over the past couple of weeks. That has a really significant impact on how high-income households feel. And it's not even the loss of wealth. It's the volatility. It's the uncertainty. Where are we going from here? What is going to cause markets to start to calm down? And I do think that even though tariffs are really hurting the good side of the economy, it's the wealth effect that will start to bleed into the services side of the economy. And we see that things like air travel, package tours, hotels, those are the sectors that take a hit.
Payrolls came out on Friday. They were decent. They were fine. A lot of people said it doesn't matter. They're going to get worse. That seemed to be the response that we had on this programme. Perhaps they're right, maybe they're wrong. I don't know. But when we get CPI and PPI over the next few days, are we going to have a similar response to that data?
I do think there's a little bit of a dismissal of the incoming data because it's not incorporating the impact of these new policies. There was barely a peep on Friday after a strong payroll report. I think what we know, though, is that some of the weakness that we're getting in the GDP numbers for the first quarter are likely overstated because of some of the payback in January and February from strong holiday sales, from weather-related events. And so payrolls are showing that we're starting on stronger footing than people thought, right? So maybe we have a little bit more room to fall before we actually hit a recession. But I think at the same time, markets don't really care, right? We're waiting on when the federal layoffs really start to bleed into payrolls. We're waiting for tariffs to start to weigh on businesses, CapEx, and hiring plans. That's all yet to come. And so similar to Friday, I think there's going to be a little bit of a dismissal of the inflation data that we get over the next couple of days.
Are markets getting ahead of themselves? Are people pricing in the worst case scenario and not accounting for some of the offsets that a growing number of companies are coming up with, whether it's getting around some of the tariff plans in a lot of different creative ways, whether it's offsetting some of the margin, some of the increase potentially in price with margin reductions, trying to capture market share? I mean, a whole host of things that could potentially offset how much of a shock this is to the broader economy.
Yeah, I do think that there's possible upside scenarios. I mean, financials are a good example of this, where deregulation will eventually start to benefit financials, and capital market activity will start to come back online. So maybe something like financials is being overly punished by some of the medium-term volatility and news that are coming in. But when I think about longer run, what the stock market is really reacting to is just, what is the game plan? Are we trying to raise revenues through tariffs to offset tax cuts? That means tariffs are here to stay. Are we trying to open up global trade, and so tariffs are going to go down to zero? That's a huge upside scenario. Or are we trying to stimulate business investment in the U.S.? So tariffs are really just for negotiating. And I think, businesses could try to find these loopholes. We saw it during the 2018-2019 trade war. But until we have real clarity about what the end goal is for this tariff policy, it's going to be very difficult to see a meaningful recovery in markets.
Sarah, appreciate your time. It's good to see you.
Thanks
Sarah
for
Wolfe
having
there
me.
of Morgan Stanley, breaking down the latest and looking ahead to that CPI and PPI data later on this week. Equity futures on the S&P down across the board. We're down 2% on the S&P 500. On the Nasdaq, we're down by 1.8. On the Russell, by 2.7. In the bond market, not a source of comfort. Bond yields at the moment up another 15 basis points on a 10-year, up 14 on 30s. The headline of the morning so far. The tariffs go on overnight, as expected. The retaliation from China, raising tariffs on U.S. goods to 84%. To discuss, I'm pleased to say that joining us now is Ruchir Sharma of Rockefeller International. Ruchir, welcome to the programme, sir. We are trying to work out what this Federal Reserve should do. Should the policymakers be stepping in and providing support, or should they watch and wait to see how this plays out?
Well, I don't think there's any case for the Fed to cut interest rates given its dual mandate just now, because as I wrote in my FT op-ed this Monday, which is that the Fed has missed its inflation target for 5 years in a row. It will do so again this year and the year after that, and possibly won't get to the target now for the next couple of years, even if it does nothing at this stage. And inflation is a big concern for Americans. And the rise in consumer prices over the last 5 to 6 years has been such that it has offset the entire undershoot of the 2% inflation target that we had last decade. So if you go back to the year 2000, over the last 25 years now, what you will see is that over that time period, consumer prices today are higher by about 16% than they would have been had the Fed been meeting its 2% inflation target over the last 25 years. So that's a serious miss on inflation, and I think it's aware of that. And given the fact that some inflation expectations are already elevated, to add fuel to that fire would be a mistake. So I think that the Fed needs to be true to its mandate, and it needs to sort of, at the very least, watch. And so far, there's been no evidence that its policy has been overly restrictive.
The pushback that I've heard over the past week, and I'd love your response to it, goes a little something like this. They should focus on the downside risk to growth and not the upside risk to inflation, because anxiety around the labour market is so much higher. We don't have sufficient tightness in the labour market that would drive those second-round effects, higher wages, etc. What would you say back to that?
Well, this has been the same easy money crowd, which has been, which is always calling for lower interest rates. So I think that that's been the real problem. One of the basic problems of the U.S. economy is that it's been fed on a diet of easy money for far too long, whether it's monetary policy or fiscal policy. And I think that's coming back to bite the U.S. And what's happening today is a demonstration of that, which is that I can't remember seeing a day in my memory where on the U.S. markets, all three major indicators are down: U.S. stocks, U.S. bonds, and the U.S. dollar. So there's a real loss of confidence happening here as far as the U.S. is concerned. This is almost like the kind of scene that I see in emerging markets, that, where you see cross assets declining together like this. And in emerging markets, I don't think any central bank would think about cutting interest rates in such an environment.
Do you think that we're getting a little ahead of ourselves with trying to give a narrative to the move in markets right now, given that there are basis trades unwinding and hedge funds that are deleveraging?
Well, it's still unprecedented. I agree that there's nothing that sort of extraordinary going on. If you look at the scenes we have seen in 2008, that kind of market panic, we are far from that. But we don't want to get to that point. So I think that the whole issue here is the fact that let's acknowledge that we have seen a very unusual move in asset prices, and that this accident in a way was waiting to happen. As you know, that at the end of last year, I had sort of called this the mother of all bubbles, this American exceptionalism trade where everybody was flooding into the American market as if there was no other market in the world to invest in. 80% of all equity market flows around the world this decade went into just America. So it's this big unwind taking place, I think, of that bubble. Now, you can argue that it would have happened regardless of Trump and tariffs, but his moves have obviously precipitated this. But as someone put it, that the air is coming out of that balloon, but that air was put in the balloon before that. And as I've argued in the past, the combination of very easy monetary and fiscal policies is what has got us into this place today.
How much further does it have to go then? If that's the theory that, yes, this is partly because of what's going on right now with policy uncertainty and the actual policies being put in place, but it also has to do with the buildup over so many years that you call a bubble. How much further do we have to go to create a level that you feel more comfortable investing in?
Well, I think that this marks a major regime shift, which is that the U.S. market had outperformed the rest of the world for 15 years, as you know. And in the last couple of years, that reached what we call a parabolic stage, where it just went completely vertical, where U.S. markets totally disconnected from the rest of the world. They, in fact, were sucking capital out from the rest of the world. So I think that this has many years to go, that what we're seeing today is the opening act of this major trend reversal in capital flows. But this is a multi-year trend. That people love to say that don't bet against America. The American stock market eventually always comes back and has been a great performer over very long stretches of time. All true. But if you look at those very long stretches of time, which go back to the year 1900 when we have data, that the US stock market in 6 of the past 11 decades has in fact underperformed the rest of the world. And we've just had a 15-year incredible spell of US market outperformance, with both the dollar doing well and the US stock market doing well. I suspect for at least the rest of the decade, both the dollar and the US stock market to significantly underperform the rest of the world. So I think that this is a regime shift precipitated by what Trump is doing, but something which predates him.
In this regime shift, do you think we need to start worrying about potentially a firm blowing up like Melvin Capital Management did in 2022?
Well, I think, there is a lot of leverage out there which we'll only know about when this happens. Like, what are the marks today for private credit, for example? Have they, started marking their assets down or not? Private equity. So I think that there is a lot of follow-through action that we have to see. What we've seen so far is only in the public markets. My concern is that the longer this lasts, which I think it could, then you have to sort of start marking down private assets, and then we have to see what really happens, because that's where a lot of the buildup in excesses has taken place. So I think that, yes, we are going to find out where all the leverage is, and that's what the Fed should be doing now. It should be out there looking at where will this stress emerge of this big decline in public markets, because so much of the froth and so much of the excesses are lying in the private markets outside of the regular eye.
Second time we've heard that this morning. Ruchir Sharma of Rockefeller International. Ruchir, appreciate your time, sir. Thank you very much. The dash for cash. Jefferies this morning. Treasury market volatility is intensifying. It's starting to resemble the spring 2020 dash for cash. It's never a good sign. That's what we're seeing right now off the back of just extreme risk aversion driven by uncertainty around the US economy.
Sell what you can, not what you want. That is not what you want to see. And that was what spurred the Fed to really come in a big way back in 2020. This is a different type of shock, and it's not clear exactly how much ammunition they have.
Bond yields up again this morning by 14 basis points on a 10-year and a 30-year yield. The 30-year this morning, 490 in the equity market on the S&P 500 at the moment. Equities are declining across the board here. On the S&P, we're down by 1.5%. With an update on stories elsewhere, with your Bloomberg brief, here's Danny Berger. Hey, Danny.
Hey, John. Oil is sinking to a 4-year low. Brent and NYMEX futures both below $60 a barrel for the first time since 2021. President President Trump's tariffs are forcing analysts and traders to rethink demand outlooks. Both Goldman Sachs and Morgan Stanley have at least halved their outlook for oil consumption growth this year. The Wall Street Journal reporting moments ago that the Trump administration is revising its plan to impose port fees on Chinese-built vessels. The new plan will base fees on vessel capacity, resulting in lower fees for smaller ships. U.S. Trade Representative Jamieson Greer told the Senate that the revisions are based on public feedback. A former Meta executive plans to testify before Congress that the company briefed the Chinese Communist Party on emerging technologies, including AI. Meta has denied the claims, writing in a statement, "Mark Zuckerberg was public about our interest in offering our services in China, and details were widely reported beginning over a decade ago. The fact is, we do not operate in China today." And that's your Bloomberg Brief. John.
Hey, Danny, thank you. Great work this morning, as always. Up next on the programme, we'll set you up for the day ahead from New York. You're watching Bloomberg TV. Equities at the moment negative across the board, recovering somewhat though as we work our way towards the opening bell. We're down 1% on the S&P. On the Nasdaq we're down by 0.6. On the Russell we're down by 1.7. Your day and week ahead looks like this. Later on this afternoon, 1 p.m, the Treasury auctioning $39 billion of 10-year notes. Look out for that because yields are up at the moment by 16 basis points. Then later, Fed minutes. Then at 2:30, the president signing more executive orders. Tomorrow, CPI, plus another round of jobless claims. On Friday, PPI and UMich sentiment. Plus, earnings season continues. The banks, JP Morgan, Wells Fargo, Morgan Stanley, all reporting on Friday morning. Joining us now from the nation's capital is Tyler Kendall. Tyler, welcome back to the program. So, big action overnight. Big retaliation from China. How is the administration responding to that snapback from China?
Yeah, hey, John. Well, Treasury Secretary Scott Bessent in an interview a little while ago said that he was confident that the trade dispute with China could be reached at the highest of levels. He said that President Trump has a good working relationship with Xi Jinping, though we should note that there has been a call between the two leaders since President Trump was inaugurated. And just yesterday, President Trump said that he was waiting for a phone call from Beijing. Importantly, though, Bessent went on to say that everything is on the table when it comes to China. When asked if the U.S. would go as far as removing some Chinese companies from U.S. exchanges, he didn't rule it out and went on to talk about the potential need for more export capital controls. Now, I will add that we did potentially see a shift even more towards the optimistic, not necessarily with China, but with some other trade deals. The secretary said to expect a, quote, rapid succession of deals. He named Japan, South Korea, India, and the U.K. as countries that this White House is all engaging with.
Tyler, appreciate the update. Tyler Kendall down in Washington, D.C. Look out for more coverage from Washington, D.C. with Tyler throughout today. This from the Treasury Secretary just moments ago. There is a little uncertainty about the economy. Still, we are in pretty good shape. The message from the Treasury Secretary this morning.
Well, I would say there's a lot more uncertainty about the economy, and that is stemming from policy in Washington, D.C., and it depends who you ask in the administration. Me, Josh Wingrove, Saleha Mohsen have a story out today that actually Peter Navarro wanted it to be even more aggressive when it came to these tariffs. Depends on who you talk to that is surrounding the president on potentially where this is going to go. Negotiation or new rules of the road.
A little uncertainty. I think a lot of people might disagree in markets right now. It seems like uncertainty. You cannot overstate that. The commentary from CEOs is getting more pointed. And I think that is marking a shift after they remained on the sidelines for a long time. Jamie Dimon in comments earlier this morning talking about the probability that a recession is a likely outcome and saying that he has put some headcount controls in place. Not yet forcing cuts to the workforce, but reflecting that this will cause credit problems. They have lost a few deals to potentially local businesses. You're just hearing a little bit more detail from some of those executives.
Bracing for another wild day in financial markets. Equities recovering just a touch, still lower by 0.8% on the S&P 500. The bond market is not recovering just yet. Bond yields are higher by 15 basis points on a 10-year maturity. Coming up tomorrow, we'll catch up with Russ Kostrick of BlackRock, Stuart Kaiser of Citi, Wally Adeyemo, the former Deputy Treasury Secretary under President Biden, and Erica Najarian of UBS, looking ahead to those bank earnings on Friday. CPI is just around the corner. Just around the corner, more volatility, I'm sure. From New York City this morning, good morning to you all. Thank you very much for choosing Bloomberg TV. This was Bloomberg Surveillance.